Commentary on Chapter 8. The happiness of those who want to be popular depends on others. The happiness of those who seek pleasure fluctuates with moods outside their control. But the happiness of the wise grows out of their own free acts. Marcus Aurelius. Dr. Jekyll and Mr. Market. Most of the time, the market is mostly accurate in pricing most stocks. Millions of buyers and sellers haggling over price do a remarkably good job of valuing companies, on average. But sometimes, the price is not right. Occasionally, it is very wrong indeed. At such times, you need to understand Graham's image of Mr. Market, probably the most brilliant metaphor ever created for explaining how stocks can become mispriced. The manic-depressive Mr. Market does not always price stocks the way an appraiser or a private buyer would value a business. Instead, when stocks are going up, he happily pays more than their objective value, and when they're going down, he's desperate to dump them for less than their true worth. Is Mr. Market still around? Is he still bipolar? You bet he is. On March 17th, 2000, the stock of Inktomi Corporation hit a new high of $231.63. Since they first came on the market in June 1998, shares in the internet searching software company had gained roughly 1,900%. Just in the few weeks since December 1999, the stock had nearly tripled. What was going on at Inktomi the business that could make Inktomi the stock so valuable? The answer seems obvious. Phenomenally fast growth. In the 3 months ending in December 1999, Inktomi sold $36 million in products and services, more than it had in the entire year ending in December 1998. If Inktomi could sustain its growth rate of the previous 12 months for just 5 more years, its revenues would explode from $36 million a quarter to $5 billion a month. With such growth in sight, the faster the stock went up, the farther up it seemed certain to go. But in his wild love affair with Inktomi's stock, Mr. Market was overlooking something about its business. The company was losing money. Lots of it. It had lost $6 million in the most recent quarter, $24 million in the 12 months before that, and $24 million in the year before that. In its entire corporate lifetime, Inktomi had never made a dime in profits. Yet on March 17th, 2000, Mr. Market valued this tiny business at a total of $25 billion. Yes, that's billion with a B. And then Mr. Market went into a sudden, nightmarish depression. On September 30th, 2002, just 2.5 years after hitting $231.62 per share, Inktomi stock closed at 25 cents, collapsing from a total market value of $25 billion to less than $40 million. Had Inktomi's business dried up? Not at all. Over the previous 12 months, the company had generated $113 million in revenues. So what had changed? Only Mr. Market's mood. In early 2000, investors were so wild about the internet that they priced Inktomi shares at 250 times the company's revenues. Now, however, they would pay only 0.35 times its revenues. Mr. Market had morphed from Dr. Jekyll to Mr. Hyde, and was ferociously trashing every stock that had made a fool out of him. But Mr. Market was no more justified in his midnight rage than he had been in his manic euphoria. On December 23, 2002, Yahoo Incorporated announced that it would buy Inktomi for $1.65 per share. That was nearly 7 times Inktomi's stock price on September 30th. History will probably show that Yahoo got a bargain. When Mr. Market makes stocks so cheap, it's no wonder that entire companies get bought right out from under him. Think for yourself. Would you willingly allow a certifiable lunatic to come by at least 5 times a week to tell you that you should feel exactly the way he feels? Would you ever agree to be euphoric just because he is, or miserable just because he thinks you should be? Of course not. You'd insist on your right to take control of your own emotional life, based on your experiences and your beliefs. But when it comes to their financial lives, millions of people let Mr. Market tell them how to feel and what to do, despite the obvious fact that from time to time he can get nuttier than a fruitcake. In 1999, when Mr. Market was squealing with delight, American employees directed an average of 8.6% of their paychecks into their 401k retirement plans. By 2002, after Mr. Market had spent 3 years stuffing stocks into black garbage bags, the average contribution rate had dropped by nearly 1/4 to just 7%. The cheaper stocks got, the less eager people became to buy them, because they were imitating Mr. Market instead of thinking for themselves. The intelligent investor shouldn't ignore Mr. Market entirely. Instead, you should do business with him, but only to the extent that it serves your interests. Mr. Market's job is to provide you with prices. Your job is to decide whether it is to your advantage to act on them. You do not have to trade with him just because he constantly begs you to. By refusing to let Mr. Market be your master, you transform him into your servant. After all, even when he seems to be destroying values, he is creating them elsewhere. In 1999, the Wilshire 5000 Index, the broadest measure of U.S. stock performance, gained 23.8%, powered by technology and telecommunications stocks. But 3,743 of the 7,234 stocks in the Wilshire Index went down in value, even as the average was rising. While those high-tech and telecom stocks were hotter than the hood of a race car on an August afternoon, thousands of old economy shares were frozen in the mud, getting cheaper and cheaper. The stock of CMGI, an incubator or holding company for internet startup firms, went up an astonishing 939.9% in 1999. Meanwhile, Berkshire Hathaway, the holding company through which Graham's greatest disciple, Warren Buffett, owns such old economy stalwarts as Coca-Cola, Gillette, and the Washington Post Company, dropped by 24.9%. But then, as it so often does, the market had a sudden mood swing. Figure 8.1, which can be found on the enhancement, offers a sampling of how the stinkers of 1999 became the stars of 2000 through 2002. As for those two holding companies, CMGI went on to lose 96% in 2000, another 70.9% in 2001, and still 39.8% more in 2002. A cumulative loss of 99.3%. Berkshire Hathaway went up 26.6% in 2000 and 6.5% in 2001. Then had a slight 3.8% loss in 2002, a cumulative gain of 30%. Can you beat the pros at their own game? One of Graham's most powerful insights is this: the investor who permits himself to be stampeded or unduly worried by unjustified market declines in his holdings is perversely transforming his basic advantage into a basic disadvantage. What does Graham mean by those words, basic advantage? He means that the intelligent individual investor has the full freedom to choose whether or not to follow Mr. Market. You have the luxury of being able to think for yourself. The typical money manager, however, has no choice but to mimic Mr. Market's every move, buying high, selling low, marching almost mindlessly in his erratic footsteps. Here's some of the handicaps mutual fund managers and other professional investors are saddled with. With billions of dollars under management, they must gravitate toward the biggest stocks, the only ones they can buy in the multi-million-dollar quantities they need to fill their portfolios. Thus, many funds end up owning the same few overpriced giants. Investors tend to pour more money into funds as the market rises. The managers use that new cash to buy more of the stocks they already own, driving prices to even more dangerous heights. If fund investors ask for their money back when the market drops, the managers may need to sell stocks to cash them out. Just as the funds are forced to buy stocks at inflated prices in a rising market, they become forced sellers as stocks get cheap again. Many portfolio managers get bonuses for beating the market, so they obsessively measure their returns against benchmarks like the S&P 500 index. If a company gets added to an index, hundreds of funds compulsively buy it. If they don't and that stock then does well, the managers look foolish. On the other hand, if they buy it and it does poorly, no one will blame them. Increasingly, fund managers are expected to specialize. Just as in medicine, the general practitioner has given way to the pediatric allergist and the geriatric otolaryngologist, fund managers must buy only small growth stocks, or only mid-sized value stocks, or nothing but large blend stocks. If a company gets too big, or too small, or too cheap, or an itty bit too expensive, the fund has to sell it, even if the manager loves the stock. So there's no reason you can't do as well as the pros. What you cannot do, despite all the pundits who say you can, is to beat the pros at their own game. The pros can't even win their own game. Why should you want to play it at all? If you follow their rules, you will lose, since you'll end up as much a slave to Mr. Market as the professionals are. Instead, recognize that investing intelligently is about controlling the controllable. You can't control whether the stocks or funds you buy will outperform the market today, next week, this month, or this year. In the short run, your returns will always be hostage to Mr. Market and his whims. But you can control your brokerage costs by trading rarely, patiently, and cheaply. Your ownership costs by refusing to buy mutual funds with excessive annual expenses. Your expectations by using realism, not fantasy, to forecast your returns. Your risk by deciding how much of your total assets to put at hazard in the stock market, by diversifying and by rebalancing. Your tax bills by holding stocks for at least 1 year, and whenever possible for at least 5 years, to lower your capital gains liability. And, most of all, your own behavior. If you listen to financial TV or read most market columnists, you'd think that investing is some kind of sport, or a war, or a struggle for survival in a hostile wilderness. But investing isn't about beating others at their game, it's about controlling yourself at your own game. The challenge for the intelligent investor is not to find the stocks that will go up the most and down the least, but rather to prevent yourself from being your own worst enemy, from buying high just because Mr. Market says buy, and from selling low just because Mr. Market says sell. If your investment horizon is long, at least 25 or 30 years, there's only one sensible approach. Buy every month, automatically, and whenever else you can spare some money. The single best choice for this lifelong holding is a total stock market index fund. Sell only when you need the cash. For a psychological boost, clip out and sign your investment owner's contract, which you can find on page 225. To be an intelligent investor, you must also refuse to judge your financial success by how a bunch of total strangers are doing. You're not one penny poor if someone in Dubuque or Dallas or Denver beats the S&P 500 and you don't. No one's gravestone reads, "He beat the market." I once interviewed a group of retirees in Boca Raton, one of Florida's wealthiest retirement communities. I asked these people, mostly in their 70s, if they had beaten the market over their investing lifetimes. Some said yes, some said no. Most weren't sure. Then one man said, "Who cares? All I know is my investments earn me enough to end up in Boca." Could there be a more perfect answer? After all, the whole point of investing is not to earn more money than average, but to earn enough money to meet your own needs. The best way to measure your investing success is not by whether you're beating the market, but by whether you've put in place a financial plan and a behavioral discipline that are likely to get you where you want to go. In the end, what matters isn't crossing the finish line before anybody else, but just making sure that you do cross it. Your money and your brain. Why then do investors find Mr. Market so seductive? It turns out that our brains are hardwired to get us into investing trouble. Humans are pattern-seeking animals. Psychologists have shown that if you present people with a random sequence and tell them that it's unpredictable, they will nevertheless insist on trying to guess what's coming next. Likewise, we know that the next roll of the dice will be a 7, that a baseball player is due for a base hit, that the next winning number in the Powerball lottery will definitely be 4, 27, 9, 16, 42, 10, and that this hot little stock is the next Microsoft. Groundbreaking new research in neuroscience shows that our brains are designed to perceive trends even where they might not exist. After an event occurs just 2 or 3 times in a row, regions of the human brain called the anterior cingulate and nucleus accumbens automatically anticipate that it will happen again. If it does repeat, a natural chemical called dopamine is released, flooding your brain with a soft euphoria. Thus, if a stock goes up a few times in a row, you reflexively expect it to keep going, and your brain chemistry changes as the stock rises, giving you a natural high. You effectively become addicted to your own predictions. But when stocks drop, that financial loss fires up your amygdala, the part of the brain that processes fear and anxiety and generates the famous fight-or-flight response that is common to all cornered animals. Just as you can't keep your heart rate from rising if a fire alarm goes off, just as you can't avoid flinching if a rattlesnake slithers onto your hiking path, you can't help feeling fearful when stock prices are plunging. In fact, the brilliant psychologists Daniel Kahneman and Amos Tversky have shown that the pain of financial loss is more than twice as intense as the pleasure of an equivalent gain. Making $1,000 on a stock feels great, but a $1,000 loss wields an emotional wallop more than twice as powerful. Losing money is so painful that many people, terrified at the prospect of any further loss, sell out near the bottom or refuse to buy more. That helps explain why we fixate on the raw magnitude of a market decline and forget to put the loss in proportion. So if a TV reporter hollers, "The market is plunging! The Dow is down 100 points!" most people instinctively shudder. But at the Dow's recent level of 8,000, that's a drop of just 1.2%. Now think how ridiculous it would sound if on a day when it's 81 degrees outside, the TV weatherman shrieked, "The temperature is plunging! It's dropped from 81 degrees to 80 degrees!" That too is a 1.2% drop. When you forget to view changing market prices in percentage terms, it's all too easy to panic over minor vibrations. If you have decades of investing ahead of you, there's a better way to visualize the financial news broadcasts. See the sidebar on page 222. In the late 1990s, many people came to feel that they were in the dark unless they checked the prices of their stocks several times a day. But as Graham puts it, the typical investor would be better off if his stocks had no market quotation at all, for he would then be spared the mental anguish caused him by other persons' mistakes of judgment. If after checking the value of your stock portfolio at 1:24 p.m., you feel compelled to check it all over again at 1:37 p.m., ask yourself these questions. Did I call a real estate agent to check the market price of my house at 1:24 p.m.? Did I call back at 1:37 p.m.? If I had, would the price have changed? If it did, would I have rushed to sell my house? By not checking, or even knowing, the market price of my house from minute to minute, do I prevent its value from rising over time? The only possible answer to these questions is of course not. And you should view your portfolio the same way. Over a 10 or 20 or 30-year investment horizon, Mr. Market's daily dipsy-doodles simply do not matter. In any case, for anyone who will be investing for years to come, falling stock prices are good news, not bad, since they enable you to buy more for less money. The longer and further stocks fall, and the more steadily you keep buying as they drop, the more money you'll make in the end. If you remain steadfast until the end. Instead of fearing a bear market, you should embrace it. The intelligent investor should be perfectly comfortable owning a stock or mutual fund, even if the stock market stops supplying daily prices for the next 10 years. Paradoxically, you will be much more in control, explains neuroscientist Antonio Damasio, if you realize how much you are not in control. By acknowledging your biological tendency to buy high and sell low, you can admit the need to dollar-cost average, rebalance, and sign an investment contract. By putting much of your portfolio on permanent autopilot, you can fight the prediction addiction. Focus on your long-term financial goals, and tune out Mr. Market's mood swings. When Mr. Market gives you lemons, make lemonade. Although Graham teaches you that you should buy when Mr. Market is yelling, "Sell!" there's one exception the intelligent investor needs to understand. Selling into a bear market can make sense if it creates a tax windfall. The U.S. Internal Revenue Code allows you to use your realized losses, any declines in value that you lock in by selling your shares, to offset up to $3,000 in ordinary income. Let's say you bought 200 shares of Coca-Cola stock in January 2000 for $60 a share, a total investment of $12,000. By year-end 2002, the stock was down to $44 a share, or $8,800 for your lot, a loss of $3,200. You could have done what most people do, either whine about your loss or sweep it under the rug and pretend it never happened. Or you could have taken control. Before 2002 ended, you could have sold all your Coke shares, locking in the $3,200 loss. Then, after waiting 31 days to comply with IRS rules, you would buy 200 shares of Coke all over again. The result? You would be able to reduce your taxable income by $3,000 in 2002, and you could use the remaining $200 loss to offset your income in 2003. And better yet, you would still own a company whose future you believe in, but now you would own it for almost 1/3 less than you paid the first time. With Uncle Sam subsidizing your losses, it can make sense to sell and lock in a loss. If Uncle Sam wants to make Mr. Market look logical by comparison, who are we to complain? News you could use. Stocks are crashing, so you turn on the television to catch the latest market news. But instead of CNBC or CNN, imagine that you can tune in to the Benjamin Graham Financial Network. On BGFN, the audio doesn't capture that famous sour clang of the market's closing bell. The video doesn't home in on brokers scurrying across the floor of the stock exchange like angry rodents. Nor does BGFN run any footage of investors gasping on frozen sidewalks as red arrows whiz overhead on electronic stock tickers. Instead, the image that fills your TV screen is the facade of the New York Stock Exchange, festooned with a huge banner reading, "Sale! 50% off!" As intro music, Bachman-Turner Overdrive can be heard blaring a few bars of their old barn burner, "You Ain't Seen Nothin' Yet." Then the anchorman announces brightly, "Stocks became more attractive yet again today, as the Dow dropped another 2.5% on heavy volume, the 4th day in a row that stocks have gotten cheaper." Tech investors fared even better, as leading companies like Microsoft lost nearly 5% on the day, making them even more affordable. That comes on top of the good news of the past year, in which stocks have already lost 50%, putting them at bargain levels not seen in years. And some prominent analysts are optimistic that prices may drop still further in the weeks and months to come. The newscast cuts over to market strategist Ignaz Anderson of the Wall Street firm of Ketchum and Skinner, who says, "My forecast is for stocks to lose another 15% by June. I'm cautiously optimistic that if everything goes well, the stocks could lose 25%, maybe more. Let's hope Ignaz Anderson is right, the anchor says cheerily. Falling stock prices would be fabulous news for any investor with a very long horizon. And now over to Wally Wood for our exclusive AccuWeather forecast. Investment Owner's Contract. I hereby state that I am an investor who is seeking to accumulate wealth for many years into the future. I know that there will be many times when I will be tempted to invest in stocks or bonds because they have gone or are going up in price, and other times when I will be tempted to sell my investments because they have gone or are going down. I hereby declare my refusal to let a herd of strangers make my financial decisions for me. I further make a solemn commitment never to invest because the stock market has gone up, and never to sell because it has gone down. Instead, I will invest per month, every month, through an automatic investment plan, or dollar-cost averaging program, into the following mutual funds, or diversified portfolios. I will also invest additional amounts whenever I can afford to spare the cash, and can afford to lose it in the short run. I hereby declare that I will hold each of these investments continually through at least the following date, which must be a minimum of 10 years after the date of this contract. The only exceptions allowed under the terms of this contract are a sudden pressing need for cash, like a healthcare emergency or the loss of my job, or a planned expenditure like a housing down payment or a tuition bill. I am, by signing below, stating my intention not only to abide by the terms of this contract, but to reread this document whenever I'm tempted to sell any of my investments. This contract is valid only when signed by at least one witness, and must be kept in a safe place that is easily accessible for future reference. Chapter 9. Investing in Investment Funds. One course open to the defensive investor is to put his money into investment company shares. Those that are redeemable on demand by the holder at net asset value are commonly known as mutual funds or open-end funds. Most of these are actively selling additional shares through a corps of salesmen. Those with non-redeemable shares are called closed-end companies or funds. The number of their shares remains relatively constant. All of the funds of any importance are registered with the Securities and Exchange Commission, SEC, and are subject to its regulations and controls. The industry is a very large one. At the end of 1970, there were 383 funds registered with the SEC, having assets totaling $54.6 billion. Of these, 356 companies with $50.6 billion were mutual funds, and 27 companies with $4 billion were closed-end. There are different ways of classifying the funds. One is by the broad division of their portfolio. They are balanced funds if they have a significant, generally about 1/3, component of bonds, or stock funds if their holdings are nearly all common stocks. There are some other varieties here, such as bond funds, hedge funds, letter stock funds, etc. Another is by their objectives, as their primary aim is for income, price stability, or capital appreciation, growth. Another distinction is by their method of sale. Load funds add a selling charge, generally about 9% of asset value on minimum purchases, to the value before charge. Others, known as no-load funds, make no such charge. The managements are content with the usual investment counsel fees for handling the capital. Since they cannot pay salesmen's commissions, the size of the no-load funds tends to be on the low side. The buying and selling prices of the closed-end funds are not fixed by the companies, but fluctuate in the open market, as does the ordinary corporate stock. Most of the companies operate under special provisions of the income tax law, designed to relieve the shareholders from double taxation on their earnings. In effect, the funds must pay out virtually all their ordinary income, for example, dividends and interest received, less expenses. In addition, they can pay out their realized long-term profits on sales of investments in the form of capital gain dividends, which are treated by the shareholder as if they were his own security profits. There is another option here, which we omit to avoid clutter. Nearly all the funds have but one class of security outstanding. A new wrinkle, introduced in 1967, divides the capitalization into a preferred issue, which will receive all the ordinary income, and a capital issue, or common stock, which will receive all the profits on security sales. These are called dual-purpose funds. Many of the companies that state their primary aim is for capital gains concentrate on the purchase of the so-called growth stocks, and they often have the word growth in their name. Some specialize in a designated area such as chemicals, aviation, overseas investments. This is usually indicated in their titles. The investor who wants to make an intelligent commitment in fund shares has thus a large and somewhat bewildering variety of choices before him, not too different from those offered in direct investment. In this chapter we shall deal with some major questions, viz. 1. Is there any way by which the investor can assure himself of better-than-average results by choosing the right funds? Sub-question, what about the performance funds? 2. If not, how can he avoid choosing funds that will give him worse-than-average results? 3. Can he make intelligent choices between different types of funds, for example, balanced versus all-stock, open-end versus closed-end, load versus no-load? Investment fund performance as a whole. Before trying to answer these questions, we should say something about the performance of the fund industry as a whole. Has it done a good job for its shareholders? In the most general way, how have fund investors fared as against those who made their investments directly? We are quite certain that the funds in the aggregate have served a useful purpose. They have promoted good habits of savings and investment. They have protected countless individuals against costly mistakes in the stock market. They brought their participants income and profits commensurate with the overall returns from common stocks. On a comparative basis, we would hazard the guess that the average individual who put his money exclusively in investment fund shares in the past 10 years has fared better than the average person who made his common stock purchases directly. The last point is probably true even though the actual performance of the funds seems to have been no better than that of common stocks as a whole, and even though the cost of investing in mutual funds may have been greater than that of direct purchases. The real choice of the average individual has not been between constructing and acquiring a well-balanced common stock portfolio, or doing the same thing a bit more expensively by buying into the funds. More likely his choice has been between succumbing to the wiles of the doorbell-ringing mutual fund salesman on the one hand, as against succumbing to the even wilier and much more dangerous peddlers of second- and third-rate new offerings. We cannot help thinking, too, that the average individual who opens a brokerage account with the idea of making conservative common stock investments is likely to find himself beset by untoward influences in the direction of speculation and speculative losses. These temptations should be much less for the mutual fund buyer. But how have the investment funds performed as against the general market? This is a somewhat controversial subject, but we shall try to deal with it in simple but adequate fashion. Table 9.1, shown on the enhancement, gives some calculated results for 1961 through 1970 of our 10 largest stock funds at the end of 1970, but choosing only the largest one from each management group. It summarizes the overall return of each of these funds for 1961 through 1965, 1966 through 1970, and for the single years 1969 and 1970. We also give average results based on the sum of one share of each of the 10 funds. These companies had combined assets of over $15 billion at the end of 1969, or about one-third of all the common stock funds. Thus, they should be fairly representative of the industry as a whole. In theory, there should be a bias in this list on the side of better-than-industry performance, since these better companies should have been entitled to more rapid expansion than the others, but this may not be the case in practice. Some interesting facts can be gathered from this table. First, we find that the overall results of these 10 funds for 1961 through 1970 were not appreciably different from those of the Standard & Poor's 500 stock composite average, or the S&P 425 industrial stock average, but they were definitely better than those of the DJIA. This raises the intriguing question as to why the 30 giants in the DJIA did worse than the much more numerous and apparently rather miscellaneous list used by Standard & Poor's. A second point is that the fund's aggregate performance as against the S&P index has improved somewhat in the last 5 years, compared with the preceding 5. The fund's gain ran a little lower than S&P's in 1961 through 1965, and a little higher than S&P's in 1966 through 1970. The third point is that a wide difference exists between the results of the individual funds. We do not think the mutual fund industry can be criticized for doing no better than the market as a whole. Their managers and their professional competitors administer so large a portion of all marketable common stocks that what happens to the market as a whole must necessarily happen approximately to the sum of their funds. Note that the trust assets of insured commercial banks included $181 billion of common stocks at the end of 1969. If we add to this the common stocks and accounts handled by investment advisors, plus the $56 billion of mutual and similar funds, we must conclude that the combined decisions of these professionals pretty well determine the movements of the stock averages, and that the movement of the stock averages pretty well determines the fund's aggregate results. Are there better-than-average funds, and can the investor select these so as to obtain superior results for himself? Obviously, all investors could not do this, since in that case we would soon be back where we started, with no one doing better than anyone else. Let us consider the question first in a simplified fashion. Why shouldn't the investor find out what fund has made the best showing of the lot over a period of sufficient years in the past? Assume from this that its management is the most capable and will therefore do better than average in the future, and put his money in that fund. This idea appears the more practicable because, in the case of the mutual funds, he could obtain this most capable management without paying any special premium for it, as against the other funds. By contrast, among non-investment corporations, the best managed companies sell at correspondingly high prices in relation to their current earnings and assets. The evidence on this point has been conflicting over the years, but our Table 9.1, found on the enhancement, covering the 10 largest funds, indicates that the results shown by the top 5 performers of 1961 through 1965 carried over, on the whole, through 1966 through 1970, even though 2 of this set did not do as well as 2 of the other 5. Our studies indicate that the investor in mutual fund shares may properly consider comparative performance over a period of years in the past, say at least 5, provided the data do not represent a large net upward movement of the market as a whole. In the latter case, spectacularly favorable results may be achieved in unorthodox ways, as will be demonstrated in our following section on performance funds. Such results, in themselves, may indicate only that the fund managers are taking undue speculative risks, and getting away with same, for the time being. Performance funds. One of the new phenomena of recent years was the appearance of the cult of performance in the management of investment funds, and even of many trust funds. We must start this section with the important disclaimer that it does not apply to the large majority of well-established funds, but only to a relatively small section of the industry which has attracted a disproportionate amount of attention. The story is simple enough. Some of those in charge set out to get much better than average, or DJIA, results. They succeeded in doing this for a while, garnering considerable publicity and additional funds to manage. The aim was legitimate enough. Unfortunately, it appears that in the context of investing really sizable funds, the aim cannot be accomplished without incurring sizable risks. And in a comparatively short time, the risks came home to roost. Several of the circumstances surrounding the performance phenomenon caused ominous headshaking by those of us whose experience went far back, even to the 1920s, and whose views, for that very reason, were considered old-fashioned and irrelevant to this second new era. In the first place, and on this very point, nearly all these brilliant performers were young men, in their 30s and 40s, whose direct financial experience was limited to the all-but continuous bull market of 1948 through 1968. Secondly, they often acted as if the definition of a sound investment was a stock that was likely to have a good rise in the market in the next few months. This led to large commitments in newer ventures, at prices completely disproportionate to their assets or recorded earnings. They could be justified only by a combination of naive hope in the future accomplishments of these enterprises, with an apparent shrewdness in exploiting the speculative enthusiasms of the uninformed and greedy public. This section will not mention people's names, but we have every reason to give concrete examples of companies. The performance fund most in the public's eye was undoubtedly Manhattan Fund, Incorporated, organized at the end of 1965. Its first offering was of 27 million shares at $9.25 to $10 per share. The company started out with $247 million of capital. Its emphasis was, of course, on capital gains. Most of its funds were invested in issues selling at high multipliers of current earnings, paying no dividends, or very small ones. With a large speculative following and spectacular price movements, the fund showed an overall gain of 38.6% in 1967, against 11% for the S&P Composite Index. But thereafter, its performance left much to be desired, as is shown in Table 9.2, found on the enhancement. The portfolio of Manhattan Fund at the end of 1969 was unorthodox, to say the least. It is an extraordinary fact that 2 of its largest investments were in companies that filed for bankruptcy within 6 months thereafter, and a third faced creditors' actions in 1971. It is another extraordinary fact that shares of at least one of these doomed companies were bought not only by investment funds, but by university endowment funds, the trust departments of large banking institutions, and the like. A third extraordinary fact was that the founder-manager of Manhattan Fund sold his stock in a separately organized management company to another large concern for over $20 million in its stock. At that time, the management company sold had less than $1 million in assets. This is undoubtedly one of the greatest disparities of all times between the results for the manager and the managees. A book published at the end of 1969 provided profiles of 19 men who are tops at the demanding game of managing billions of dollars of other people's money. The summary told us further that they are young. Some earn more than $1 million a year. They are a new financial breed. They all have a total fascination with the market and a spectacular knack for coming up with winners. A fairly good idea of the accomplishments of this top group can be obtained by examining the published results of the funds they manage. Such results are available for funds directed by 12 of the 19 persons described in the Money Managers. Typically enough, they showed up well in 1966, and brilliantly in 1967. In 1968, their performance was still good in the aggregate, but mixed as to individual funds. In 1969, they all showed losses, with only one managing to do a bit better than the S&P Composite Index. In 1970, their comparative performance was even worse than in 1969. We have presented this picture in order to point a moral, which perhaps can best be expressed by the old French proverb, plus ça change, plus c'est la même chose. Bright, energetic people, usually quite young, have promised to perform miracles with other people's money since time immemorial. They have usually been able to do it for a while, or at least to appear to have done it, and they have inevitably brought losses to their public in the end. About a half-century ago, the miracles were often accompanied by flagrant manipulation, misleading corporate reporting, outrageous capitalization structures, and other semi-fraudulent financial practices. All this brought on an elaborate system of financial controls by the SEC, as well as a cautious attitude toward common stocks on the part of the general public. The operations of the new money managers in 1965 through 1969 came a little more than one full generation after the shenanigans of 1926 through 1929. The specific malpractices banned after the 1929 crash were no longer resorted to. They involved the risk of jail sentences. But in many corners of Wall Street, they were replaced by newer gadgets and gimmicks that produced very similar results in the end. Outright manipulation of prices disappeared, but there were many other methods of drawing the gullible public's attention to the profit possibilities in hot issues. Blocks of letter stock could be bought well below the quoted market price, subject to undisclosed restrictions on their sale. They could immediately be carried in the reports at their full market value, showing a lovely and illusory profit, and so on. It is amazing how, in a completely different atmosphere of regulation and prohibitions, Wall Street was able to duplicate so much of the excesses and errors of the 1920s. No doubt there will be new regulations and new prohibitions. The specific abuses of the late 1960s will be fairly adequately banned from Wall Street. But it is probably too much to expect that the urge to speculate will ever disappear, or that the exploitation of that urge can ever be abolished. It is part of the armament of the intelligent investor to know about these extraordinary popular delusions, and to keep as far away from them as possible. The picture of most of the performance funds is a poor one, if we start after their spectacular record in 1967. With the 1967 figures included, their overall showing is not at all disastrous. On that basis, one of the money managers' operators did quite a bit better than the S&P Composite Index. 3 did distinctly worse, and 6 did about the same. Let us take as a check another group of performance funds, the 10 that made the best showing in 1967, with gains ranging from 84% up to 301% in that single year. Of these, 4 gave a better overall 4-year performance than the S&P index, if the 1967 gains are included, and 2 excelled the index in 1968 through 1970. None of these funds was large, and the average size was about $60 million. Thus, there is a strong indication that smaller size is a necessary factor for obtaining continued outstanding results. The foregoing account contains the implicit conclusion that there may be special risks involved in looking for superior performance by investment fund managers. All financial experience up to now indicates that large funds, soundly managed, can produce, at best, only slightly better than average results over the years. If they are unsoundly managed, they can produce spectacular but largely illusory profits for a while, followed inevitably by calamitous losses. There have been instances of funds that have consistently outperformed the market averages for, say, 10 years or more, but these have been scarce exceptions, having most of their operations in specialized fields, with self-imposed limits on the capital employed, and not actively sold to the public. Closed-end versus open-end funds. Almost all the mutual funds or open-end funds, which offer their holders the right to cash in their shares at each day's valuation of the portfolio, have a corresponding machinery for selling new shares. By this means, most of them have grown in size over the years. The closed-end companies, nearly all of which were organized a long time ago, have a fixed capital structure, and thus have diminished in relative dollar importance. Open-end companies are being sold by many thousands of energetic and persuasive salesmen. The closed-end shares have no one especially interested in distributing them. Consequently, it has been possible to sell most mutual funds to the public at a fixed premium of about 9% above net asset value to cover salesmen's commissions, etc., while the majority of closed-end shares have been consistently obtainable at less than their asset value. This price discount has varied among individual companies, and the average discount for the group as a whole has also varied from one date to another. Figures on this point for 1961 through 1970 are given in Table 9.3, which can be found on the enhancement. It does not take much shrewdness to suspect that the lower relative price for closed-end as against open-end shares has very little to do with the difference in the overall investment results between the two groups. That this is true is indicated by the comparison of the annual results from 1961 through 1970 of the two groups, included in Table 9.3. Thus we arrive at one of the few clearly evident rules for investors' choices. If you want to put money in investment funds, buy a group of closed-end shares at a discount of, say, 10% to 15% from asset value, instead of paying a premium of about 9% above asset value for shares of an open-end company. Assuming that the future dividends and changes in asset values continue to be about the same for the two groups, you will thus obtain about 1/5 more for your money from the closed-end shares. The mutual fund salesman will be quick to counter with the argument, but if you own closed-end shares, you can never be sure what price you can sell them for. The discount can be greater than it is today, and you'll suffer from the wider spread. With our shares, you're guaranteed the right to turn in your shares at 100% of asset value, never less. Let us examine this argument a bit. It'll be a good exercise in logic and plain common sense. Question. Assuming that the discount on closed-end shares does widen, how likely is it that you'll be worse off with those shares than with an otherwise equivalent purchase of open-end shares? This calls for a little arithmetic. Assume that investor A buys some open-end shares at 109% of asset value, and investor B buys closed-end shares at 85% thereof, plus 1.5% commission. Both sets of shares earn and pay 30% of this asset value in, say, 4 years, and end up with the same value as at the beginning. Investor A redeems his shares at 100% of value, losing the 9% premium he paid. His overall return for the period is 30% less 9%, or 21% on asset value. This, in turn, is 19% on his investment. How much must investor B realize on his closed-end shares to obtain the same return on his investment as investor A? The answer is 73%, or a discount of 27% from asset value. In other words, the closed-end man could suffer a widening of 12 points in the market discount, about double, before his return would get down to that of the open-end investor. An adverse change of this magnitude has happened rarely, if ever, in the history of closed-end shares. Hence, it is very unlikely that you will obtain a lower overall return from a representative closed-end company, bought at a discount, if its investment performance is about equal to that of a representative mutual fund. If a small load or no load fund is substituted for one with the usual 8.5% load, the advantage of the closed-end investment is of course reduced, but it remains an advantage. The fact that a few closed-end funds are selling at premiums greater than the true 9% charge on most mutual funds introduces a separate question for the investor. Do these premium companies enjoy superior management of sufficient proven worth to warrant their elevated prices? If the answer is sought in the comparative results for the past 5 or 10 years, the answer would appear to be no. 3 of the 6 premium companies have mainly foreign investments. A striking feature of these is the large variation in prices in a few years' time. At the end of 1970, one sold at only 1/4 of its high, another at 1/3, another at less than half. If we consider the 3 domestic companies selling above asset value, we find that the average of their 10-year overall returns was somewhat better than that of 10 discount funds. But the opposite was true in the last 5 years. A comparison of the 1961 through 1970 record of Lehman Corporation and of General American Investors, 2 of our oldest and largest closed-end companies, is given in Table 9.5. Take a look at it on the enhancement. One of these sold 14% above, and the other 7.6% below its net asset value at the end of 1970. The difference in price to net asset relationships did not appear warranted by these figures. Investment in balanced funds. The 23 balanced funds covered in the Weisenberger report had between 25% and 59% of their assets in preferred stocks and bonds, the average being just 40%. The balance was held in common stocks. It would appear more logical for the typical investor to make his bond-type investments directly, rather than to have them form part of a mutual fund commitment. The average income return shown by these balanced funds in 1970 was only 3.9% per annum on asset value, or say 3.6% on the offering price. The better choice for the bond component would be the purchase of United States savings bonds, or corporate bonds rated A or better, or tax-free bonds, for the investor's bond portfolio. Commentary on Chapter 9. The school teacher asks Billy Bob, "If you have 12 sheep and one jumps over the fence. How many sheep do you have left? Billy Bob answers, "None." "Well," says the teacher, "you sure don't know your subtraction." "Maybe not," Billy Bob replies, "but I darn sure know my sheep." An old Texas joke. Almost perfect. A purely American creation, the mutual fund was introduced in 1924 by a former salesman of aluminum pots and pans named Edward G. Leffler. Mutual funds are quite cheap, very convenient, generally diversified, professionally managed, and tightly regulated under some of the toughest provisions of federal securities law. By making investing easy and affordable for almost anyone, the funds have brought some 54 million American families, and millions more around the world, into the investing mainstream, probably the greatest advance in financial democracy ever achieved. But mutual funds aren't perfect. They are almost perfect, and that word makes all the difference. Because of their imperfections, most funds underperform the market, overcharge their investors, create tax headaches, and suffer erratic swings in performance. The intelligent investor must choose funds with great care in order to avoid ending up owning a big fat mess. Top of the charts. Most investors simply buy a fund that has been going up fast, on the assumption that it will keep on going. And why not? Psychologists have shown that humans have an inborn tendency to believe that the long run can be predicted from even a short series of outcomes. What's more, we know from our own experience that some plumbers are far better than others, that some baseball players are much more likely to hit home runs, that our favorite restaurant serves consistently superior food, and that smart kids get consistently good grades. Skill and brains and hard work are recognized, rewarded, and consistently repeated all around us. So if a fund beats the market, our intuition tells us to expect it to keep right on outperforming. Unfortunately, in the financial markets, luck is more important than skill. If a manager happens to be in the right corner of the market at just the right time, he will look brilliant. But all too often, what was hot suddenly goes cold, and the manager's IQ seems to shrivel by 50 points. Figure 9.1, found on the enhancement, shows what happened to the hottest funds of 1999. This is yet another reminder that the market's hottest market sector, in 1999 that was technology, often turns as cold as liquid nitrogen, with blinding speed and utterly no warning. And it's a reminder that buying funds based purely on their past performance is one of the stupidest things an investor can do. Financial scholars have been studying mutual fund performance for at least a half-century, and they are virtually unanimous on several points. The average fund does not pick stocks well enough to overcome its costs of researching and trading them. The higher a fund's expenses, the lower its returns. The more frequently a fund trades its stocks, the less it tends to earn. Highly volatile funds, which bounce up and down more than average, are likely to stay volatile. Funds with high past returns are unlikely to remain winners for long. Your chances of selecting the top-performing funds of the future on the basis of their returns in the past are about as high as the odds that Bigfoot and the abominable snowman will both show up in pink ballet slippers at your next cocktail party. In other words, your chances are not zero, but they're pretty close. But there's good news, too. First of all, understanding why it's so hard to find a good fund will help you become a more intelligent investor. Second, while past performance is a poor predictor of future returns, there are other factors that you can use to increase your odds of finding a good fund. Finally, a fund can offer excellent value even if it doesn't beat the market, by providing an economical way to diversify your holdings, and by freeing up your time for all the other things you would rather be doing than picking your own stocks. The first shall be last. Why don't more winning funds stay winners? The better a fund performs, the more obstacles its investors face. Migrating managers. When a stock picker seems to have the Midas touch, everyone wants him, including rival fund companies. If you bought Transamerica Premier Equity Fund to cash in on the skills of Glenn Bickerstaff, who gained 47.5% in 1997, you were quickly out of luck. TCW snatched him away in mid-1998 to run its TCW Galileo Select Equities Fund, and the Transamerica Fund lagged the market in 3 of the next 4 years. If you bought Fidelity Aggressive Growth Fund in early 2000 to capitalize on the high returns of Erin Sullivan, who had nearly tripled her shareholders' money since 1997, oh well. She quit to start her own hedge fund in 2000, and her former fund lost more than 3/4 of its value over the next 3 years. Asset elephantiasis. When a fund earns high returns, investors notice, often pouring in hundreds of millions of dollars in a matter of weeks. That leaves the fund manager with few choices, all of them bad. He can keep that money safe for a rainy day, But then the low returns on cash will crimp the fund's results if stocks keep going up. He can put the new money into the stocks he already owns, which have probably gone up since he first bought them, and will become dangerously overvalued if he pumps in millions of dollars more. Or he can buy new stocks he didn't like well enough to own already, but he will have to research them from scratch and keep an eye on far more companies than he's used to following. Finally, when the $100 million Nimble Fund puts 2% of its assets, or $2 million, in Minnow Corporation, a stock with a total market value of $500 million, it's buying up less than 0.5% of Minnow. But if hot performance swells the Nimble Fund to $10 billion, then an investment of 2% of its assets would total $200 million, nearly half the entire value of Minnow, a level of ownership that isn't even permissible under federal law. If Nimble's portfolio manager still wants to own small stocks, he'll have to spread his money over vastly more companies, and probably end up spreading his attention too thin. No more fancy footwork. Some companies specialize in incubating their funds, test driving them privately before selling them publicly. Typically, the only shareholders are employees and affiliates of the fund company itself. By keeping them tiny, the sponsor can use these incubated funds as guinea pigs for risky strategies that work best with small sums of money, like buying truly tiny stocks or rapid-fire trading of initial public offerings. If its strategy succeeds, the fund can lure public investors en masse by publicizing its private returns. In other cases, the fund manager waives or skips charging management fees, raising the net return, then slaps the fees on later after the high returns attract plenty of customers. Almost without exception, the returns of incubated and fee-waived funds have faded into mediocrity after outside investors poured millions of dollars into them. Rising expenses. It often costs more to trade stocks in very large blocks than in small ones. With fewer buyers and sellers, it's harder to make a match. A fund with $100 million in assets might pay 1% a year in trading costs. But if high returns send the fund mushrooming up to $10 billion, its trades could easily eat up at least 2% of those assets. The typical fund holds onto its stocks for only 11 months at a time, so trading costs eat away at returns like a corrosive acid. Meanwhile, the other costs of running a fund rarely fall, and sometimes even rise, as assets grow. With operating expenses averaging 1.5% and trading costs at around 2%, the typical fund has to beat the market by 3.5 percentage points per year before costs, just to match it after costs. Sheepish behavior. Finally, once a fund becomes successful, its managers tend to become timid and imitative. As a fund grows, its fees become more lucrative, making its managers reluctant to rock the boat. The very risks that the managers took to generate their initial high returns could now drive investors away, and jeopardize all that fat fee income. So the biggest funds resemble a herd of identical and overfed sheep, all moving in sluggish lockstep, all saying "bah" at the same time. Nearly every growth fund owns Cisco and GE and Microsoft and Pfizer and Walmart, and in almost identical proportions. This behavior is so prevalent that finance scholars simply call it herding. But by protecting their own fee income, fund managers compromise their ability to produce superior returns for their outside investors. Because of their fat costs and bad behavior, most funds fail to earn their keep. No wonder high returns are nearly as perishable as unrefrigerated fish. What's more, as time passes, the drag of their excessive expenses leaves most funds farther and farther behind, as Figure 9.2 shows. Take a look at it on the enhancement. What then should the intelligent investor do? First of all, recognize that an index fund, which owns all the stocks in the market, all the time, without any pretense of being able to select the best and avoid the worst, will beat most funds over the long run. If your company doesn't offer a low-cost index fund in your 401k, organize your coworkers and petition to have one added. Its rock-bottom overhead, operating expenses of 0.2% annually, and yearly trading costs of just 0.1%, give the index fund an insurmountable advantage. If stocks generate, say, a 7% annualized return over the next 20 years, a low-cost index fund like Vanguard Total Stock Market will return just under 6.7%. That would turn a $10,000 investment into more than $36,000. But the average stock fund, with its 1.5% in operating expenses and roughly 2% in trading costs, will be lucky to gain 3.5% annually. That would turn $10,000 into just under $20,000, or nearly 50% less than the result from the index fund. Index funds have only one significant flaw. They're boring. You'll never be able to go to a barbecue and brag about how you own the top-performing fund in the country. You'll never be able to boast that you beat the market, because the job of an index fund is to match the market's return, not to exceed it. Your index fund manager is not likely to roll the dice and gamble that the next great industry will be teleportation, or scratch-and-sniff websites, or telepathic weight loss clinics. The fund will always own every stock, not just one manager's best guess at the next new thing. But as the years pass, the cost advantage of indexing will keep accruing relentlessly. Hold an index fund for 20 years or more, adding new money every month, and you're all but certain to outperform the vast majority of professional and individual investors alike. Late in his life, Graham praised index funds as the best choice for individual investors, as does Warren Buffett. Tilting the tables. When you add up all their handicaps, the wonder is not that so few funds beat the index, but that any do. And yet some do. What qualities do they have in common? Their managers are the biggest shareholders. The conflict of interest between what's best for the fund's managers and what's best for its investors is mitigated when the managers are among the biggest owners of the fund's shares. Some firms, like Longleaf Partners, even forbid their employees from owning anything but their own funds. At Longleaf and other firms like Davis and FPA, the managers own so much of the funds that they're likely to manage your money as if it were their own, lowering the odds that they'll jack up fees, let the funds swell to gargantuan size, or whack you with a nasty tax bill. A fund's proxy statement and statement of additional information, both available from the Securities and Exchange Commission through the Edgar database at www.sec.gov, disclose whether the managers own at least 1% of the fund's shares. They're cheap. One of the most common myths in the fund business is that you get what you pay for, that high returns are the best justification for higher fees. There are two problems with this argument. First, it isn't true. Decades of research have proven that funds with higher fees earn lower returns over time. Secondly, high returns are temporary, while high fees are nearly as permanent as granite. If you buy a fund for its hot returns, you may well end up with a handful of cold ashes, but your costs of owning the fund are almost certain not to decline when its returns do. They dare to be different. When Peter Lynch ran Fidelity Magellan, he bought whatever seemed cheap to him, regardless of what other fund managers owned. In 1982, his biggest investment was Treasury bonds. Right after that, he made Chrysler his top holding, even though most experts expected the automaker to go bankrupt. Then, in 1986, Lynch put almost 20% of Fidelity Magellan in foreign stocks like Honda, Norsk Hydro, and Volvo. So, before you buy a U.S. stock fund, compare the holdings listed in its latest report against the roster of the S&P 500 index. If they look like Tweedledee and Tweedledum, shop for another fund. They shut the door. The best funds often close to new investors, permitting only their existing shareholders to buy more. That stops the feeding frenzy of new buyers who want to pile in at the top, and protects the fund from the pains of asset elephantiasis. It's also a signal that the fund managers are not putting their own wallets ahead of yours. But the closing should occur before, not after, the fund explodes in size. Some companies with an exemplary record of shutting their own gates are Longleaf, Numeric, Oakmark, T. Rowe Price, Vanguard, and Wasatch. They don't advertise. Just as Plato says in the Republic that the ideal rulers are those who do not want to govern, the best fund managers often behave as if they don't want your money. They don't appear constantly on financial television or run ads boasting of their #1 returns. The steady Little Mares and Power Growth Fund didn't even have a website until 2001, and still sells its shares in only 24 states. The Teray Fund has never run a retail advertisement since its launch in 1990. What else should you watch for? Most fund buyers look at past performance first, then at the manager's reputation, then at the riskiness of the fund, and finally, if ever, at the fund's expenses. The intelligent investor looks at those same things, but in the opposite order. Since a fund's expenses are far more predictable than its future risk or return, you should make them your first filter. There's no good reason ever to pay more than these levels of annual operating expenses by fund category. Taxable and municipal bonds, 0.75%. U.S. equities, large and mid-sized stocks, 1%. High-yield junk bonds, 1%. U.S. equities, small stocks, 1.25%. Foreign stocks, 1.5%. Next, evaluate risk. In its prospectus, or buyer's guide, every fund must show a bar graph displaying its worst loss over a calendar quarter. If you can't stand losing at least that much money in 3 months, go elsewhere. It's also worth checking a fund's Morningstar rating. A leading investment research firm, Morningstar awards star ratings to funds based on how much risk they took to earn their returns. 1 star is the worst, 5 is the best. But just like past performance itself, these ratings look back in time. They tell you which funds were the best, not which are going to be. 5-star funds, in fact, have a disconcerting habit of going on to underperform 1-star funds. So first find a low-cost fund whose managers are major shareholders. Dare to be different. Don't hype their returns, and have shown a willingness to shut down before they get too big for their britches. Then, and only then, consult their Morningstar rating. Finally, look at past performance, remembering that it is only a pale predictor of future returns. As we've already seen, yesterday's winners often become tomorrow's losers. But researchers have shown that one thing is almost certain. Yesterday's losers almost never become tomorrow's winners. So avoid funds with consistently poor past returns, especially if they have above-average annual expenses. The closed world of closed-end funds. Closed-end stock funds, although popular during the 1980s, have slowly atrophied. Today, there are only 30 diversified domestic equity funds, many of them tiny, trading only a few hundred shares a day, with high expenses and weird strategies, like Morgan Fund Shares, which specializes in the stocks of habit-forming industries like booze, casinos, and cigarettes. Research by closed-end fund expert Donald Cassidy of Lipper Incorporated reinforces Graham's earlier observations. Diversified closed-end stock funds trading at a discount not only tend to outperform those trading at a premium, but are likely to have a better return than the average open-end mutual fund. Sadly, however, diversified closed-end stock funds are not always available at a discount in what has become a dusty, dwindling market. But there are hundreds of closed-end bond funds with especially strong choices available in the municipal bond area. When these funds trade at a discount, their yield is amplified, and they can be attractive, so long as their annual expenses are below the thresholds listed before. The new breed of exchange-traded index funds can be worth exploring as well. These low-cost ETFs sometimes offer the only means by which an investor can gain entree to a narrow market, like, say, companies based in Belgium, or stocks in the semiconductor industry. Other index ETFs offer much broader market exposure. However, they are generally not suitable for investors who wish to add money regularly, since most brokers will charge a separate commission on every new investment you make. Know when to fold them. Once you own a fund, how can you tell when it's time to sell? The standard advice is to ditch a fund if it underperforms the market, or similar portfolios, for 1, or is it 2, or is it 3 years in a row? But this advice makes no sense. From its birth in 1970 through 1999, the Sequoia Fund underperformed the S&P 500 index in 12 out of its 29 years, or more than 41% of the time. Yet Sequoia gained more than 12,500% over that period, versus 4,900% for the index. The performance of most funds falters simply because the type of stocks they prefer temporarily goes out of favor. If you hired a manager to invest in a particular way, why fire him for doing what he promised? By selling when a style of investing is out of fashion, you not only lock in a loss, but you lock yourself out of the all but inevitable recovery. One study showed that mutual fund investors underperformed their own funds by 4.7 percentage points annually from 1998 through 2001, simply by buying high and selling low. So when should you sell? Here are a few definite red flags. A sharp and unexpected change in strategy, such as a value fund loading up on technology stocks in 1999, or a growth fund buying tons of insurance stocks in 2002. An increase in expenses, suggesting that the managers are lining their own pockets. Large and frequent tax bills, generated by excessive trading. Suddenly erratic returns, as when a formerly conservative fund generates a big loss, or even produces a giant gain. Why we love our Ouija boards. Believing, or even just hoping, that we can pick the best funds of the future makes us feel better. It gives us the pleasing sensation that we are in charge of our own investment destiny. This I'm in control here feeling is part of the human condition. It's what psychologists call overconfidence. Here are just a few examples of how it works. In 1999, Money Magazine asked more than 500 people whether their portfolios had beaten the market. 1 in 4 said yes. When asked to specify their returns, however, 80% of those investors reported gains lower than the markets. 4% had no idea how much their portfolios rose, but were sure they had beaten the market anyway. A Swedish study asked drivers who had been in severe car crashes to rate their own skills behind the wheel. These people, including some the police had found responsible for the accidents, and others who had been so badly injured that they answered the survey from their hospital beds, insisted they were better than average drivers. In a poll taken in late 2000, Time and CNN asked more than 1,000 likely voters whether they thought they were in the top 1% of the population by income. 19% placed themselves among the richest 1% of Americans. In late 1997, a survey of 750 investors found that 74% believed their mutual fund holdings would consistently beat the Standard & Poor's 500 each year, even though most funds fail to beat the S&P 500 in the long run, and many fail to beat it in any year. While this kind of optimism is a normal sign of a healthy psyche, that doesn't make it good investment policy. It makes sense to believe you can predict something only if it actually is predictable. Unless you're realistic, your quest for self-esteem will end up in self-defeat. As the investment consultant Charles Ellis puts it, if you're not prepared to stay married, you shouldn't get married. Fund investing is no different. If you're not prepared to stick with a fund through at least 3 lean years, you shouldn't buy it in the first place. Patience is the fund investor's single most powerful ally. Chapter 10. The Investor and His Advisors. The investment of money in securities is unique among business operations, in that it is almost always based in some degree on advice received from others. The great bulk of investors are amateurs. Naturally, they feel that in choosing their securities, they can profit by professional guidance. Yet there are peculiarities inherent in the very concept of investment advice. If the reason people invest is to make money, then in seeking advice, they are asking others to tell them how to make money. That idea has some element of naivete. Businessmen seek professional advice on various elements of their business, but they do not expect to be told how to make a profit. That is their own bailiwick. When they, or non-business people, rely on others to make investment profits for them, they are expecting a kind of result for which there is no true counterpart in ordinary business affairs. If we assume that there are normal or standard income results to be obtained from investing money in securities, then the role of the advisor can be more readily established. He will use his superior training and experience to protect his clients against mistakes, and to make sure that they obtain the results to which their money is entitled. It is when the investor demands more than an average return on his money, or when his advisor undertakes to do better for him, that the question arises whether more is being asked or promised than is likely to be delivered. Advice on investments may be obtained from a variety of sources. These include 1. A relative or friend, presumably knowledgeable in securities. 2. A local commercial banker. 3. A brokerage firm or investment banking house. 4. A financial service or periodical. And 5. An investment counselor. The miscellaneous character of this list suggests that no logical or systematic approach in this matter has crystallized, as yet, in the minds of investors. Certain common-sense considerations relate to the criterion of normal or standard results mentioned before. Our basic thesis is this. If the investor is to rely chiefly on the advice of others in handling his funds, then either he must limit himself and his advisors strictly to standard, conservative, and even unimaginative forms of investment, or he must have an unusually intimate and favorable knowledge of the person who is going to direct his funds into other channels. But if the ordinary business or professional relationship exists between the investor and his advisors, he can be receptive to less conventional suggestions, only to the extent that he himself has grown in knowledge and experience, and has therefore become competent to pass independent judgment on the recommendations of others. He is then passed from the category of defensive or unenterprising investor into that of aggressive or enterprising investor. Investment counsel and trust services of banks. The truly professional investment advisors, that is, the well-established investment counsel firms who charge substantial annual fees, are quite modest in their promises and pretensions. For the most part, they place their clients' funds in standard interest and dividend-paying securities, and they rely mainly on normal investment experience for their overall results. In the typical case, it is doubtful whether more than 10% of the total fund is ever invested in securities other than those of leading companies, plus government bonds, including state and municipal issues. Nor do they make a serious effort to take advantage of swings in the general market. The leading investment counsel firms make no claim to being brilliant. They do pride themselves on being careful, conservative, and competent. Their primary aim is to conserve the principal value over the years and produce a conservatively acceptable rate of income. Any accomplishment beyond that, and they do strive to better the goal, they regard in the nature of extra service rendered. Perhaps their chief value to their clients lies in shielding them from costly mistakes. They offer as much as the defensive investor has the right to expect from any counselor serving the general public. What we've said about the well-established investment counsel firms applies generally to the trust and advisory services of the larger banks. Financial services. The so-called financial services are organizations that send out uniform bulletins, sometimes in the form of telegrams, to their subscribers. The subjects covered may include the state and prospects of business, the behavior and prospect of the securities markets, and information and advice regarding individual issues. There is often an inquiry department which will answer questions affecting an individual subscriber. The cost of the service averages much less than the fee that investment counselors charge their individual clients. Some organizations, notably Babson's and Standard & Poor's, operate on separate levels as a financial service and an investment counsel. Incidentally, other organizations such as Scudder, Stevens & Clark operate separately as investment counsel and as one or more investment funds. The financial services direct themselves on the whole to a quite different segment of the public than do the investment counsel firms. The latter's clients generally wish to be relieved of bother and the need for making decisions. The financial services offer information and guidance to those who are directing their own financial affairs or are themselves advising others. Many of these services confine themselves exclusively, or nearly so, to forecasting market movements by various technical methods. We shall dismiss these with the observation that their work does not concern investors, as the term is used in this audiobook. On the other hand, some of the best known, such as Moody's Investment Service and Standard & Poor's, are identified with statistical organizations that compile the voluminous statistical data that form the basis for all serious security analysis. These services have a varied clientele, ranging from the most conservative-minded investor to the rankest speculator. As a result, they must find it difficult to adhere to any clear-cut or fundamental philosophy in arriving at their opinions and recommendations. An old-established service of the type of Moody's and the others must obviously provide something worthwhile to a broad class of investors. What is it? Basically, they address themselves to the matters in which the average active investor-speculator is interested, and their views on these either command some measure of authority or at least appear more reliable than those of the unaided client. For years, the financial services have been making stock market forecasts without anyone taking this activity very seriously. Like everyone else in the field, they're sometimes right and sometimes wrong. Wherever possible, they hedge their opinions so as to avoid the risk of being proved completely wrong. There is a well-developed art of Delphic phrasing that adjusts itself successfully to whatever the future brings. In our view, perhaps a prejudiced one, this segment of their work has no real significance, except for the light it throws on human nature in the securities markets. Nearly everyone interested in common stocks wants to be told by someone else what he thinks the market is going to do. The demand being there, it must be supplied. Their interpretations and forecasts of business conditions, of course, are much more authoritative and informing. These are an important part of the great body of economic intelligence which is spread continuously among buyers and sellers of securities, and tends to create fairly rational prices for stocks and bonds under most circumstances. Undoubtedly, the material published by the financial services adds to the store of information available and fortifies the investment judgment of their clients. It is difficult to evaluate their recommendations of individual securities. Each service is entitled to be judged separately, and the verdict could properly be based only on an elaborate and inclusive study covering many years. In our own experience, we have noted among them a pervasive attitude which we think tends to impair what could otherwise be more useful advisory work. This is their general view that a stock should be bought if the near-term prospects of the business are favorable, and should be sold if these are unfavorable, regardless of the current price. Such a superficial principle often prevents the services from doing the sound analytical job of which their staffs are capable, namely to ascertain whether a given stock appears over or undervalued at the current price, in the light of its indicated long-term future earning power. The intelligent investor will not do his buying and selling solely on the basis of recommendations received from a financial service. Once this point is established, the role of the financial service then becomes the useful one of supplying information and offering suggestions. Advice from brokerage houses. Probably the largest volume of information and advice to the security-owning public comes from stockbrokers. These are members of the New York Stock Exchange and of other exchanges who execute buying and selling orders for a standard commission. Practically all the houses that deal with the public maintain a statistical or analytical department, which answers inquiries and makes recommendations. A great deal of analytical literature, some of it elaborate and expensive, is distributed gratis to the firm's customers, more impressively referred to as clients. A great deal is at stake in the innocent-appearing question whether customers or clients is the more appropriate name. A business has customers. A professional person or organization has clients. The Wall Street brokerage fraternity has probably the highest ethical standards of any business, but it is still feeling its way toward the standards and standing of a true profession. In the past, Wall Street has thrived mainly on speculation, and stock market speculators as a class were almost certain to lose money. Hence, it has been logically impossible for brokerage houses to operate on a thoroughly professional basis. To do that would have required them to direct their efforts toward reducing rather than increasing their business. The farthest that certain brokerage houses have gone in that direction, and could have been expected to go, is to refrain from inducing or encouraging anyone to speculate. Such houses have confined themselves to executing orders given them, to supplying financial information or analyses, and to rendering opinions on the investment merits of securities. Thus, in theory at least, they are devoid of all responsibility for either the profits or the losses of their speculative customers. Most stock exchange houses, however, still adhere to the old-time slogans that they are in business to make commissions, and that the way to succeed in business is to give the customers what they want. Since the most profitable customers want speculative advice and suggestions, the thinking and activities of the typical firm are pretty closely geared to day-to-day trading in the market. Thus, it tries hard to help its customers make money in a field where they are condemned almost by mathematical law to lose in the end. By this we mean that the speculative part of their operations cannot be profitable over the long run for most brokerage house customers. But to the extent that their operations resemble true investing, they may produce investment gains that more than offset the speculative losses. The investor obtains advice and information from stock exchange houses through two types of employees, now known officially as customers' brokers or account executives, and financial analysts. The customer's broker, also called a registered representative, formerly bore the less dignified title of customer's man. Today he is for the most part an individual of good character and considerable knowledge of securities, who operates under a rigid code of right conduct. Nevertheless, since his business is to earn commissions, he can hardly avoid being speculation-minded. Thus, the security buyer who wants to avoid being influenced by speculative considerations will ordinarily have to be careful and explicit in his dealing with his customer's broker. He will have to show clearly, by word and deed, that he is not interested in anything faintly resembling a stock market tip. Once the customer's broker understands clearly that he has a real investor on his hands, he will respect this point of view and cooperate with it. The financial analyst, formerly known chiefly as security analyst, is a person of particular concern to the author, who has been one himself for more than 5 decades, and has helped educate countless others. At this stage, we refer only to the financial analysts employed by brokerage houses. The function of the security analyst is clear enough from his title. It is he who works up the detailed studies of individual securities, develops careful comparisons of various issues in the same field, and forms an expert opinion of the safety or attractiveness or intrinsic value of all the different kinds of stocks and bonds. By what must seem a quirk to the outsider, there are no formal requirements for being a security analyst. Contrast with this the facts that a customer's broker must pass an examination, meet the required character tests, and be duly accepted and registered by the New York Stock Exchange. As a practical matter, nearly all the younger analysts have had extensive business school training, and the oldsters have acquired at least the equivalent in the school of long experience. In the great majority of cases, the employing brokerage house can be counted on to assure itself of the qualifications and competence of its analysts. The customer of the brokerage firm may deal with the security analyst directly, or his contact may be an indirect one via the customer's broker. In either case, the analyst is available to the client for a considerable amount of information and advice. Let us make an emphatic statement here. The value of the security analyst to the investor depends largely on the investor's own attitude. If the investor asks the analyst the right questions, he is likely to get the right, or at least valuable, answers. The analysts hired by brokerage houses, we are convinced, are greatly handicapped by the general feeling that they are supposed to be market analysts as well. When they're asked whether a given common stock is sound, the question often means, is this stock likely to advance during the next few months? As a result, many of them are compelled to analyze with one eye on the stock ticker, a pose not conducive to sound thinking or worthwhile conclusions. In the next section of this audiobook, we shall deal with some of the concepts and possible achievements of security analysis. A great many analysts working for stock exchange firms could be of prime assistance to the bona fide investor who wants to be sure that he gets full value for his money, and possibly a little more. As in the case of the customer's brokers, what is needed at the beginning is a clear understanding by the analyst of the investor's attitude and objectives. Once the analyst is convinced that he's dealing with a man who is value-minded rather than quotation-minded, there is an excellent chance that his recommendations will prove of real overall benefit. The CFA Certificate for Financial Analysts. An important step was taken in 1963 toward giving professional standing and responsibility to financial analysts. The official title of Chartered Financial Analyst, CFA, is now awarded to those senior practitioners who pass required examinations and meet other tests of fitness. The subjects covered include security analysis and portfolio management. The analogy with the long-established professional title of Certified Public Accountant, CPA, is evident and intentional. This relatively new apparatus of recognition and control should serve to elevate the standards of financial analysts and eventually to place their work on a truly professional basis. Dealings with brokerage houses. One of the most disquieting developments of the period in which we write this revision has been the financial embarrassment, in plain words, bankruptcy, or near bankruptcy, of quite a few New York Stock Exchange firms, including at least 2 of considerable size. This is the first time in half a century or more that such a thing has happened, and it is startling for more than one reason. For many decades, the New York Stock Exchange has been moving in the direction of closer and stricter controls over the operations and financial condition of its members, including minimum capital requirements, surprise audits, and the like. Besides this, we have had 37 years of control over the exchanges and their members by the Securities and Exchange Commission. Finally, the stock brokerage industry itself has operated under favorable conditions, namely a huge increase in volume, fixed minimum commission rates, largely eliminating competitive fees, and a limited number of member firms. The first financial troubles of the brokerage houses in 1969 were attributed to the increase in volume itself. This, it was claimed, overtaxed their facilities, increased their overhead, and produced many troubles in making financial settlements. It should be pointed out this was probably the first time in history that important enterprises have gone broke because they had more business than they could handle. In 1970, as brokerage failures increased, they were blamed chiefly on the falling off in volume. A strange complaint when one reflects that the turnover of the NYSE in 1970 totaled 2,937 million shares, the largest volume in its history, and well over twice as large as in any year before 1965. During the 15 years of the bull market ending in 1964, the annual volume had averaged only 712 million shares, 1/4 of the 1970 figure. But the brokerage business had enjoyed the greatest prosperity in its history. If, as it appears, the member firms as a whole had allowed their overhead and other expenses to increase at a rate that could not sustain even a mild reduction in volume during part of a year, this does not speak well for either their business acumen or their financial conservatism. A third explanation of the financial trouble finally emerged out of a mist of concealment, and we suspect that it is the most plausible and significant of the 3. It seems that a good part of the capital of certain brokerage houses was held in the form of common stocks owned by the individual partners. Some of these seem to have been highly speculative and carried at inflated values. When the market declined in 1969, the quotations of such securities fell drastically, and a substantial part of the capital of the firms vanished with them. In effect, the partners were speculating with the capital that was supposed to protect the customers against the ordinary financial hazards of the brokerage business, in order to make a double profit thereon. This was inexcusable. We refrain from saying more. The investor should use his intelligence not only in formulating his financial policies, but also in the associated details. These include the choice of a reputable broker to execute his orders. Up to now, it was sufficient to counsel our listeners to deal only with a member of the New York Stock Exchange, unless he had compelling reasons to use a non-member firm. Reluctantly, we must add some further advice in this area. We think that people who do not carry margin accounts, and in our vocabulary this means all non-professional investors, should have the delivery and receipt of their securities handled by their bank. When giving a buying order to your brokers, you can instruct them to deliver the securities bought to your bank, against payment therefore by the bank. Conversely, when selling, you can instruct your bank to deliver the securities to the broker against payment of the proceeds. These services will cost a little extra, but they should be well worth the expense in terms of safety and peace of mind. This advice may be disregarded, as no longer called for, after the investor is sure that all the problems of stock exchange firms have been disposed of, but not before. Investment bankers. The term investment banker is applied to a firm that engages to an important extent in originating, underwriting, and selling new issues of stocks and bonds. To underwrite means to guarantee to the issuing corporation or other issuer that the security will be fully sold. A number of the brokerage houses carry on a certain amount of underwriting activity. Generally, this is confined to participating in underwriting groups formed by leading investment bankers. There is an additional tendency for brokerage firms to originate and sponsor a minor amount of new issue financing, particularly in the form of smaller issues of common stocks, when a bull market is in full swing. Investment banking is perhaps the most respectable department of the Wall Street community, because it is here that finance plays its constructive role of supplying new capital for the expansion of industry. In fact, much of the theoretical justification for maintaining active stock markets, notwithstanding their frequent speculative excesses, lies in the fact that organized security exchanges facilitate the sale of new issues of bonds and stocks. If investors or speculators could not expect to see a ready market for a new security offered them, they might well refuse to buy it. The relationship between the investment banker and the investor is basically that of the salesman to the prospective buyer. For many years past, the great bulk of the new offerings in dollar value has consisted of bond issues that were purchased in the main by financial institutions such as banks and insurance companies. In this business, the security salesmen have been dealing with shrewd and experienced buyers. Hence, any recommendations made by the investment bankers to these customers have had to pass careful and skeptical scrutiny. Thus, these transactions are almost always effected on a business-like footing. But a different situation obtains in a relationship between the individual security buyer and the investment banking firms, including the stockbrokers acting as underwriters. Here, the purchaser is frequently inexperienced and seldom shrewd. He is easily influenced by what the salesman tells him, especially in the case of common stock issues, since often his unconfessed desire in buying is chiefly to make a quick profit. The effect of all this is that the public investor's protection lies less in his own critical faculty than in the scruples and ethics of the offering houses. It is a tribute to the honesty and competence of the underwriting firms that they are able to combine fairly well the discordant roles of advisor and salesman. But it is imprudent for the buyer to trust himself to the judgment of the seller. In 1959, we stated at this point, the bad results of this unsound attitude show themselves recurrently in the underwriting field, and with notable effects in the sale of new common stock issues during periods of active speculation. Shortly thereafter, this warning proved urgently needed. As already pointed out, the years 1960 through 61, and again 1968 through 69, were marked by an unprecedented outpouring of issues of lowest quality, sold to the public at absurdly high offering prices, and in many cases pushed much higher by heedless speculation and some semi-manipulation. A number of the more important Wall Street houses have participated to some degree in these less than credible activities, which demonstrates that the familiar combination of greed, folly, and irresponsibility has not been exorcised from the financial scene. The intelligent investor will pay attention to the advice and recommendations received from investment banking houses, especially those known by him to have an excellent reputation. But he will be sure to bring sound and independent judgment to bear upon these suggestions, either his own, if he is competent, or that of some other type of advisor. Other advisors. It is a good old custom, especially in the smaller towns, to consult one's local banker about investments. A commercial banker may not be a thoroughgoing expert on security values, but he is experienced and conservative. He is especially useful to the unskilled investor, who is often tempted to stray from the straight and unexciting path of a defensive policy, and needs the steadying influence of a prudent mind. The more alert and aggressive investor, seeking counsel in the selection of security bargains, will not ordinarily find the commercial banker's viewpoint to be especially suited to his own objectives. We take a more critical attitude toward the widespread custom of asking investment advice from relatives or friends. The inquirer always thinks he has good reason for assuming that the person consulted has superior knowledge or experience. Our own observation indicates that it is almost as difficult to select satisfactory lay advisors as it is to select the proper securities unaided. Much bad advice is given free. Summary. Investors who are prepared to pay a fee for the management of their funds may wisely select some well-established and well-recommended investment counsel firm. Alternatively, they may use the investment department of a large trust company or the supervisory service supplied on a fee basis by a few of the leading New York Stock Exchange houses. The results to be expected are in no way exceptional, but they are commensurate with those of the average, well-informed, and cautious investor. Most security buyers obtain advice without paying for it specifically. It stands to reason, therefore, that in the majority of cases they are not entitled to and should not expect better than average results. They should be wary of all persons, whether customers, brokers, or security salesmen, who promise spectacular income or profits. This applies both to the selection of securities and to guidance in the elusive and perhaps elusive art of trading in the market. Defensive investors, as we have defined them, will not ordinarily be equipped to pass independent judgment on the security recommendations made by their advisors, but they can be explicit, and even repetitiously so, in stating the kind of securities they want to buy. If they follow our prescription, they will confine themselves to high-grade bonds and the common stocks of leading corporations, preferably those that can be purchased at individual price levels that are not high in the light of experience and analysis. The security analyst of any reputable stock exchange house can make up a suitable list of such common stocks, and can certify to the investor whether or not the existing price level, therefore, is a reasonably conservative one, as judged by past experience. The aggressive investor will ordinarily work in active cooperation with his advisors. He will want their recommendations explained in detail, and he will insist on passing his own judgment upon them. This means that the investor will gear his expectations and the character of his security operations to the development of his own knowledge and experience in the field. Only in the exceptional case, where the integrity and competence of the advisors have been thoroughly demonstrated, should the investor act upon the advice of others without understanding and approving the decision made. There have always been unprincipled stock salesmen and fly-by-night stockbrokers, and as a matter of course, we have advised our listeners to confine their dealings, if possible, to members of the New York Stock Exchange. But we are reluctantly compelled to add the extra cautious counsel that security deliveries and payments be made through the intermediary of the investor's bank. The distressing Wall Street brokerage house picture may have cleared up completely in a few years, but in late 1971, we still suggest better safe than sorry. Commentary on Chapter 10. I feel grateful to the Malaysian wench who, seeing the philosopher Thales continually spending his time in contemplation of the heavenly vault and always keeping his eyes raised upward, put something in his way to make him stumble, to warn him that it would be time to amuse his thoughts with things in the clouds when he had seen to those at his feet. Indeed, she gave him or her good counsel, to look rather to himself than to the sky. Michel de Montaigne. Do you need help? In the glory days of the late 1990s, many investors chose to go it alone. By doing their own research, picking stocks themselves, and placing their trades through an online broker, these investors bypassed Wall Street's costly infrastructure of research, advice, and trading. Unfortunately, many do-it-yourselfers asserted their independence right before the worst bear market since the Great Depression, making them feel in the end that they were fools for going it alone. That's not necessarily true, of course. People who delegated every decision to a traditional stockbroker lost money too. But many investors do take comfort from the experience, judgment, and second opinion that a good financial advisor can provide. Some investors may need an outsider to show them what rate of return they need to earn on their investments, or how much extra money they need to save in order to meet their financial goals. Others may simply benefit from having someone else to blame when their investments go down. That way, instead of beating yourself up in an agony of self-doubt, you get to criticize someone who typically can defend him or herself and encourage you at the same time. That may provide just the psychological boost you need to keep investing steadily at a time when other investors' hearts may fail them. All in all, just as there's no reason you can't manage your own portfolio, so there's no shame in seeking professional help in managing it. How can you tell if you need a hand? Here are some signals. Big losses. If your portfolio lost more than 40% of its value from the beginning of 2000 through the end of 2002, then you did even worse than the dismal performance of the stock market itself. It hardly matters whether you blew it by being lazy, reckless, or just unlucky. After such a giant loss, your portfolio is crying out for help. Busted budgets. If you perennially struggle to make ends meet, have no idea where your money goes, find it impossible to save on a regular schedule, and chronically fail to pay your bills on time, then your finances are out of control. An advisor can help you get a grip on your money by designing a comprehensive financial plan that will outline how and how much you should spend, borrow, save, and invest. Chaotic portfolios. All too many investors thought they were diversified in the late 1990s because they owned 39 different internet stocks, or 7 different U.S. growth stock funds. But that's like thinking that an all-soprano chorus can handle singing Old Man River better than a soprano soloist can. No matter how many sopranos you add, that chorus will never be able to nail all those low notes until some baritones join the group. Likewise, if all your holdings go up and down together, you lack the investing harmony that true diversification brings. A professional asset allocation plan can help. Major changes. If you've become self-employed and need to set up a retirement plan, your aging parents don't have their finances in order, or college for your kids looks unaffordable, an advisor can not only provide peace of mind, but help you make genuine improvements in the quality of your life. What's more, a qualified professional can ensure that you benefit from and comply with the staggering complexity of the tax laws and retirement rules. Trust, then verify. Remember that financial con artists thrive by talking you into trusting them, and by talking you out of investigating them. Before you place your financial future in the hands of an advisor, it's imperative that you find someone who not only makes you comfortable, but whose honesty is beyond reproach. As Ronald Reagan used to say, trust, then verify. Start off by thinking of the handful of people you know best and trust the most. Then ask if they can refer you to an advisor whom they trust and who they feel delivers good value for his fees. A vote of confidence from someone you admire is a good start. Once you have the name of the advisor and his firm, as well as his specialty, is he a stockbroker, financial planner, accountant, insurance agent? you can begin your due diligence. Enter the name of the advisor and his or her firm into an internet search engine like Google to see if anything comes up. Watch for terms like fine, complaint, lawsuit, disciplinary action, or suspension. If the advisor is a stockbroker or insurance agent, contact the Office of your state's Securities Commissioner. A convenient directory of online links is at www.nasaa.org to ask whether any disciplinary actions or customer complaints have been filed against the advisor. If you're considering an accountant who also functions as a financial advisor, your state's accounting regulators, whom you can find through the National Association of State Boards of Accountancy at www.nasba.org, will tell you whether his or her record is clean. Financial planners, or their firms, must register with either the U.S. Securities and Exchange Commission or securities regulators in the state where their practice is based. As part of that registration, the advisor must file a two-part document called Form ADV. You should be able to view and download it at www.advisorinfo.sec.gov, www.iard.com, or the website of your state securities regulator. Pay special attention to the disclosure reporting pages, where the advisor must disclose any disciplinary actions by regulators. Because unscrupulous advisors have been known to remove those pages before handing an ADV to a prospective client, you should independently obtain your own complete copy. It's a good idea to cross-check a financial planner's record at www.cfp-board.org, since some planners who've been disciplined outside their home state can fall through the regulatory cracks. For more tips on due diligence, listen to the following sidebar. Words of warning. The need for due diligence doesn't stop once you hire an advisor. Melanie Center-Lubin, Securities Commissioner for the state of Maryland, suggests being on guard for words and phrases that can spell trouble. If your advisor keeps saying them, or twisting your arm to do anything that makes you uncomfortable, then get in touch with the authorities very quickly, warns Lubin. Here's the kind of lingo that should set off warning bells. Offshore. The opportunity of a lifetime. Prime bank. This baby's gonna move. Guaranteed. You need to hurry. It's a sure thing. Our proprietary computer model. The smart money is buying it. Option strategy. It's a no-brainer. You can't afford not to own it. We can beat the market. You'll be sorry if you don't. Exclusive. You should focus on performance, not fees. Don't you want to be rich? Can't lose. The upside is huge. There's no downside. I'm putting my mother in it. Trust me. Commodities trading. Monthly returns. Active asset allocation strategy. We can cap your downside. No one else knows how to do this. Getting to know you. A leading financial planning newsletter recently canvassed dozens of advisors to get their thoughts on how you should go about interviewing them. In screening an advisor, your goals should be to determine whether he or she cares about helping clients or just goes through the motions. Establish whether he or she understands the fundamental principles of investing as they're outlined in this audiobook. Assess whether he or she is sufficiently educated, trained, and experienced to help you. Here are some of the questions that prominent financial planners recommended any prospective client should ask. Why are you in this business? What is the mission statement of your firm? Besides your alarm clock, what makes you get up in the morning? What is your investing philosophy? Do you use stocks or mutual funds? Do you use technical analysis? Do you use market timing? A yes to either of the last two questions is a no signal to you. Do you focus solely on asset management, or do you also advise on taxes, estate and retirement planning, budgeting and debt management, and insurance? How do your education, experience, and credentials qualify you to give those kinds of financial advice? What needs do your clients typically have in common? How can you help me achieve my goals? How will you track and report my progress? Do you provide a checklist that I can use to monitor the implementation of any financial plan we develop? How do you choose investments? What investing approach do you believe is most successful? And what evidence can you show me that you have achieved that kind of success for your clients? What do you do when an investment performs poorly for an entire year? Any advisor who answers sell is not worth hiring. Do you, when recommending investments, accept any form of compensation from any third party? Why or why not? Under which circumstances? How much, in actual dollars, do you estimate I would pay for your services the first year? What would make that number go up or down over time? If fees will consume more than 1% of your assets annually, you should probably shop for another advisor. How many clients do you have, and how often do you communicate with them? What has been your proudest achievement for a client? What characteristics do your favorite clients share? What's the worst experience you've had with a client, and how did you resolve it? What determines whether a client speaks to you or to your support staff? How long do clients typically stay with you? Can I see a sample account statement? If you can understand it, ask the advisor to explain it. If you can't understand his explanation, he's not right for you. Do you consider yourself financially successful? Why? How do you define financial success? How high an average annual return do you think is feasible on my investments? Anything over 8% to 10% is unrealistic. Will you provide me with your resume, your Form ADV, and at least 3 references? If the advisor or his firm is required to file an ADV and he will not provide you a copy, get up and leave, and keep one hand on your wallet as you go. Have you ever had a formal complaint filed against you? Why did the last client who fired you do so? Defeating your own worst enemy. Finally, bear in mind that great financial advisors do not grow on trees. Often the best already have as many clients as they can handle, and may be willing to take you on only if you seem like a good match. So they will ask you some tough questions as well, which might include, why do you feel you need a financial advisor? What are your long-term goals? What has been your greatest frustration in dealing with other advisors, including yourself? Do you have a budget? Do you live within your means? What percentage of your assets do you spend each year? When we look back a year from now, what will I need to have accomplished in order for you to be happy with your progress? How do you handle conflicts or disagreements? How did you respond emotionally to the bear market that began in 2000? What are your worst financial fears? Your greatest financial hopes? What rate of return on your investments do you consider reasonable? Base your answer on Chapter 3. An advisor who doesn't ask questions like these, and who does not show enough interest in you to sense intuitively what other questions you consider to be the right ones, is not a good fit. Above all else, you should trust your advisor enough to permit him or her to protect you from your worst enemy, yourself. You hire an advisor, explains commentator Nick Murray, not to manage money, but to manage you. If the advisor is a line of defense between you and your worst impulsive tendencies, says financial planning analyst Robert Veres, then he or she should have systems in place that'll help the two of you control them. Among those systems, a comprehensive financial plan that outlines how you will earn, save, spend, borrow, and invest your money. An investment policy statement that spells out your fundamental approach to investing. An asset allocation plan that details how much money you'll keep in different investment categories. These are the building blocks on which good financial decisions must be founded, and they should be created mutually by you and the advisor, rather than imposed unilaterally. You should not invest $1 or make a decision until you are satisfied that these foundations are in place and in accordance with your wishes. Chapter 11. Security Analysis for the Lay Investor. General Approach. Financial analysis is now a well-established and flourishing profession, or semi-profession. The various societies of analysts that make up the National Federation of Financial Analysts have over 13,000 members, most of whom make their living out of this branch of mental activity. Financial analysts have textbooks, a code of ethics, and a quarterly journal. They also have their share of unresolved problems. In recent years, there's been a tendency to replace the general concept of security analysis by that of financial analysis. The latter phrase has a broader implication and is better suited to describe the work of most senior analysts on Wall Street. It would be useful to think of security analysis as limiting itself pretty much to the examination and evaluation of stocks and bonds, whereas financial analysis would comprise that work, plus the determination of investment policy, portfolio selection, plus a substantial amount of general economic analysis. In this chapter, we shall use whatever designation is most applicable, with chief emphasis on the work of the security analyst proper. The security analyst deals with the past, the present, and the future of any given security issue. He describes the business. He summarizes its operating results and financial position. He sets forth its strong and weak points, its possibilities and risks. He estimates its future earning power under various assumptions, or as a best guess. He makes elaborate comparisons of various companies, or of the same company at various times. Finally, he expresses an opinion as to the safety of the issue, if it is a bond or investment-grade preferred stock, or as to its attractiveness as a purchase if it is a common stock. In doing all these things, the security analyst avails himself of a number of techniques, ranging from the elementary to the most abstruse. He may modify substantially the figures in the company's annual statements, even though they bear the sacred imprimatur of the certified public accountant. He's on the lookout particularly for items in these reports that may mean a good deal more or less than they say. The security analyst develops and applies standards of safety, by which we can conclude whether a given bond or preferred stock may be termed sound enough to justify purchase for investment. These standards relate primarily to past average earnings, but they are concerned also with capital structure, working capital, asset values, and other matters. In dealing with common stocks, the security analyst until recently has only rarely applied standards of value as well defined as were his standards of safety for bonds and preferred stocks. Most of the time he contented himself with a summary of past performances, a more or less general forecast of the future, with particular emphasis on the next 12 months, and a rather arbitrary conclusion. The latter was, and still is, often drawn with one eye on the stock ticker or the market charts. In the past few years, however, much attention has been given by practicing analysts to the problem of valuing growth stocks. Many of these have sold at such high prices in relation to past and current earnings that those recommending them have felt a special obligation to justify their purchase by fairly definite projections of expected earnings running fairly far into the future. Certain mathematical techniques of a rather sophisticated sort have perforce been invoked to support the valuations arrived at. We shall deal with these techniques, in foreshortened form, a little later. However, we must point out a troublesome paradox here, which is that the mathematical valuations have become most prevalent precisely in those areas where one might consider them least reliable. For the more dependent the valuation becomes on anticipations of the future, and the less it is tied to a figure demonstrated by past performance, the more vulnerable it becomes to possible miscalculation and serious error. A large part of the value found for a high multiplier growth stock is derived from future projections, which differ markedly from past performance, except perhaps in the growth rate itself. Thus, it may be said that security analysts today find themselves compelled to become most mathematical and scientific in the very situations which lend themselves least auspiciously to exact treatment. Let us proceed nonetheless with our discussion of the more important elements and techniques of security analysis. The present highly condensed treatment is directed to the needs of the non-professional investor. At the minimum, he should understand what the security analyst is talking about and driving at. Beyond that, he should be equipped, if possible, to distinguish between superficial and sound analysis. Security analysis for the lay investor is thought of as beginning with the interpretation of a company's annual financial report. This is a subject which we've covered for laymen in a separate book entitled The Interpretation of Financial Statements. We do not consider it necessary or appropriate to traverse the same ground in this chapter, especially since the emphasis in the present audiobook is on principles and attitudes rather than on information and description. Let us pass on two basic questions underlying the selection of investments. What are the primary tests of safety of a corporate bond or preferred stock? What are the chief factors entering into the valuation of a common stock? Bond analysis. The most dependable, and hence the most respectable, branch of security analysis concerns itself with the safety or quality of bond issues and investment-grade preferred stocks. The chief criterion used for corporate bonds is the number of times that total interest charges have been covered by available earnings for some years in the past. In the case of preferred stocks, it is the number of times that bond interest and preferred dividends combined have been covered. The exact standards applied will vary with different authorities. Since the tests are at bottom arbitrary, there is no way to determine precisely the most suitable criteria. In the 1961 revision of our textbook, Security Analysis, we recommend certain coverage standards, which appear in Table 11. Take a look at it on the enhancement. Our basic test is applied only to the average results for a period of years. Other authorities require also that a minimum coverage be shown for every year considered. We approve a poorest year test as an alternative to the 7-year average test. It would be sufficient if the bond or preferred stock met either of these criteria. It may be objected that the large increase in bond interest rates since 1961 would justify some offsetting reduction in the coverage of charges required. Obviously, it would be much harder for an industrial company to show a 7 times coverage of interest charges at 8% than at 4.5%. To meet this changed situation, we now suggest an alternative requirement related to the percent earned on the principal amount of the debt. These figures might be 33% before taxes for an industrial company, 20% for a public utility, and 25% for a railroad. It should be borne in mind here that the rate actually paid by most companies on their total debt is considerably less than the current 8% figures, since they have the benefit of older issues bearing lower coupons. The poorest year requirement could be set at about 2/3 of the 7-year requirement. In addition to the earnings coverage test, a number of others are generally applied. These include the following. 1. Size of enterprise. There is a minimum standard in terms of volume of business for a corporation, varying as between industrials, utilities, and railroads, and of population for a municipality. 2. Stock equity ratio. This is the ratio of the market price of the junior stock issues to the total face amount of the debt, or the debt plus preferred stock. It is a rough measure of the protection, or cushion, afforded by the presence of a junior investment that must first bear the brunt of unfavorable developments. This factor includes the market's appraisal of the future prospects of the enterprise. 3. Property value. The asset values, as shown on the balance sheet or as appraised, were formerly considered the chief security and protection for a bond issue. Experience has shown that in most cases, safety resides in the earning power, and if this is deficient, the assets lose most of their reputed value. Asset values, however, retain importance as a separate test of ample security for bonds and preferred stocks in three enterprise groups: public utilities, because rates may depend largely on the property investment, real estate concerns, and investment companies. At this point, the alert investor should ask, how dependable are tests of safety that are measured by past and present performance, in view of the fact that payment of interest and principal depends upon what the future will bring forth? The answer can be founded only on experience. Investment history shows that bonds and preferred stocks that have met stringent tests of safety, based on the past, have in the great majority of cases been able to face the vicissitudes of the future successfully. This has been strikingly demonstrated in the major field of railroad bonds, a field that has been marked by a calamitous frequency of bankruptcies and serious losses. In nearly every case, the roads that got into trouble had long been over-bonded, had shown an inadequate coverage of fixed charges in periods of average prosperity, and would thus have been ruled out by investors who applied strict tests of safety. Conversely, practically every road that has met such tests has escaped financial embarrassment. Our premise was strikingly vindicated by the financial history of the numerous railroads reorganized in the 1940s and in 1950. All of these, with one exception, started their careers with fixed charges, reduced to a point where the current coverage of fixed interest requirements was ample, or at least respectable. The exception was the New Haven Railroad, which in its reorganization year, 1947, earned its new charges only about 1.1 times. In consequence, while all the other roads were able to come through rather difficult times with solvency unimpaired, the New Haven relapsed into trusteeship for the third time in 1961. In Chapter 17 that follows, we shall consider some aspects of the bankruptcy of the Penn Central Railroad, which shook the financial community in 1970. An elementary fact in this case was that the coverage of fixed charges did not meet conservative standards as early as 1965. Hence, a prudent bond investor would have avoided or disposed of the bond issues of the system long before its financial collapse. Our observations on the adequacy of the past record to judge future safety apply, and to an even greater degree to the public utilities, which constitute a major area for bond investment. Receivership of a soundly capitalized electric utility company or system is almost impossible. Since Securities and Exchange Commission control was instituted, along with the breakup of most of the holding company systems, public utility financing has been sound and bankruptcies unknown. The financial troubles of electric and gas utilities in the 1930s were traceable almost 100% to financial excesses and mismanagement, which left their imprint clearly on the company's capitalization structures. Simple but stringent tests of safety, therefore, would have warned the investor away from the issues that were later to default. Among industrial bond issues, the long-term record has been different. Although the industrial group as a whole has shown a better growth of earning power than either the railroads or the utilities, it has revealed a lesser degree of inherent stability for individual companies and lines of business. Thus, in the past at least, there have been persuasive reasons for confining the purchase of industrial bonds and preferred stocks to companies that not only are of major size, but also have shown an ability in the past to withstand a serious depression. Few defaults of industrial bonds have occurred since 1950, but this fact is attributable in part to the absence of a major depression during this long period. Since 1966, there have been adverse developments in the financial position of many industrial companies. Considerable difficulties have developed as the result of unwise expansion. On the one hand, this has involved large additions to both bank loans and long-term debt. On the other, it has frequently produced operating losses instead of the expected profits. At the beginning of 1971, it was calculated that in the past 7 years, the interest payments of all non-financial firms had grown from $9.8 billion in 1963 to $26.1 billion in 1970, and that interest payments had taken 29% of the aggregate profits before interest and taxes in 1971, against only 16% in 1963. Obviously, the burden on many individual firms had increased much more than this. Overbonded companies have become all too familiar. There is every reason to repeat the caution expressed in our 1965 edition. We are not quite ready to suggest that the investor may count on an indefinite continuance of this favorable situation, and hence relax his standards of bond selection in the industrial or any other group. Common stock analysis. The ideal form of common stock analysis leads to a valuation of the issue which can be compared with the current price to determine whether or not the security is an attractive purchase. This valuation, in turn, would ordinarily be found by estimating the average earnings over a period of years in the future, and then multiplying that estimate by an appropriate capitalization factor, The now standard procedure for estimating future earning power starts with average past data for physical volume, prices received, and operating margin. Future sales in dollars are then projected on the basis of assumptions as to the amount of change in volume and price level over the previous base. These estimates, in turn, are grounded first on general economic forecasts of gross national product, and then on special calculations applicable to the industry and company in question. An illustration of this method of valuation may be taken from our 1965 edition and brought up to date by adding the sequel. The Value Line, a leading investment service, makes forecasts of future earnings and dividends by the procedure outlined before, and then derives a figure of price potentiality, of projected market value by applying a valuation formula to each issue based largely on certain past relationships. In Table 11.2, found on the enhancement, we reproduce the projections for 1967 through 1969, made in June 1964, and compare them with the earnings and average market price actually realized in 1968, which approximates the 1967 through 1969 period. The combined forecasts proved to be somewhat on the low side, but not seriously so. The corresponding predictions made 6 years before had turned out to be over-optimistic on earnings and dividends, but this had been offset by use of a low multiplier, with the result that the price potentiality figure proved to be about the same as the actual average price for 1963. The listener will note that quite a number of the individual forecasts were wide of the mark. This is an instance in support of our general view that composite or group estimates are likely to be a good deal more dependable than those for individual companies. Ideally, perhaps, the security analyst should pick out the 3 or 4 companies whose future he thinks he knows the best, and concentrate his own and his client's interests on what he forecasts for them. Unfortunately, it appears to be almost impossible to distinguish in advance between those individual forecasts which can be relied upon and those which are subject to a large chance of error. At bottom, this is the reason for the wide diversification practiced by the investment funds. For it is undoubtedly better to concentrate on one stock that you know is going to prove highly profitable, rather than dilute your results to a mediocre figure merely for diversification's sake. But this is not done, because it cannot be done dependably. The prevalence of wide diversification is in itself a pragmatic repudiation of the fetish of selectivity, to which Wall Street constantly pays lip service. Factors affecting the capitalization rate. Though average future earnings are supposed to be the chief determinant of value, the security analyst takes into account a number of other factors of a more or less definite nature. Most of these will enter into his capitalization rate, which can vary over a wide range, depending upon the quality of the stock issue. Thus, although 2 companies may have the same figure of expected earnings per share in 1973 through 1975, say $4, the analyst may value one as low as 40 and the other as high as 100. Let us deal briefly with some of the considerations that enter into these divergent multipliers. 1. General long-term prospects. No one really knows anything about what will happen in the distant future, but analysts and investors have strong views on the subject just the same. These views are reflected in the substantial differentials between the price-over-earnings ratios of individual companies and of industry groups. At this point, we added in our 1965 edition. For example, at the end of 1963, the chemical companies in the DJIA were selling at considerably higher multipliers than the oil companies, indicating stronger confidence in the prospects of the former than of the latter. Such distinctions made by the market are often soundly based, but when dictated mainly by past performance, they are as likely to be wrong as right. We shall supply here, in Table 11.3 found on the enhancement, the 1963 year-end material on the chemical and oil company issues in the DJIA, and carry their earnings to the end of 1970. It will be seen that the chemical companies, despite their high multipliers, made practically no gain in earnings in the period after 1963. The oil companies did much better than the chemicals, and about in line with the growth implied in their 1963 multipliers. Thus, our chemical stock example proved to be one of the cases in which the market multipliers were proven wrong. 2. Management. On Wall Street, a great deal is constantly said on this subject, but little that is really helpful. Until objective, quantitative, and reasonably reliable tests of managerial competence are devised and applied, this factor will continue to be looked at through a fog. It is fair to assume that an outstandingly successful company has unusually good management. This will have shown itself already in the past record. It will show up again in the estimates for the next 5 years. And once more in the previously discussed factor of long-term prospects. The tendency to count it still another time as a separate bullish consideration can easily lead to expensive overvaluations. The management factor is most useful, we think, in those cases in which a recent change has taken place that has not yet had the time to show its significance in the actual figures. 2 spectacular occurrences of this kind were associated with the Chrysler Motor Corporation. The first took place as far back as 1921, when Walter Chrysler took command of the almost moribund Maxwell Motors, and in a few years made it a large and highly profitable enterprise, while numerous other automobile companies were forced out of business. The second happened as recently as 1962, when Chrysler had fallen far from its once high estate, and the stock was selling at its lowest price in many years. Then, new interests associated with Consolidation Coal took over the reins. The earnings advanced from the 1961 figure of $1.24 per share to the equivalent of $17 in 1963, and the price rose from a low of $38.5 in 1962 to the equivalent of nearly $200 the very next year. 3. Financial strength and capital structure. Stock of a company with a lot of surplus cash and nothing ahead of the common is clearly a better purchase at the same price than another one with the same per-share earnings but large bank loans and senior securities. Such factors are properly and carefully taken into account by security analysts. A modest amount of bonds or preferred stocks, however, is not necessarily a disadvantage to the common, nor is the moderate use of seasonal bank credit. Incidentally, a top-heavy structure, too little common stock in relation to bonds and preferred, may, under favorable conditions, make for a huge, speculative profit in the common. This is the factor known as leverage. 4. Dividend record. One of the most persuasive tests of high quality is the uninterrupted record of dividend payments, going back over many years. We think that a record of continuous dividend payments for the last 20 years or more is an important plus factor in the company's quality rating. Indeed, the defensive investor might be justified in limiting his purchases to those meeting this test. 5. Current dividend rate. This, our last additional factor, is the most difficult one to deal with in satisfactory fashion. Fortunately, the majority of companies have come to follow what may be called a standard dividend policy. This has meant the distribution of about 2/3 of their average earnings, except that in the recent period of high profits and inflationary demands for more capital, the figure has tended to be lower. In 1969, it was 59.5% for the stocks in the Dow Jones average and 55% for all American corporations. Where the dividend bears a normal relationship to the earnings, the valuation may be made on either basis without substantially affecting the result. For example, a typical secondary company with expected average earnings of $3 and an expected dividend of $2 may be valued at either 12 times its earnings or 18 times its dividend to yield a value of 36 in both cases. However, an increasing number of growth companies are departing from the once standard policy of paying out 60% or more of earnings in dividends, on the grounds that the shareholders' interests will be better served by retaining nearly all the profits to finance expansion. The issue presents problems and requires careful distinctions. We have decided to defer our discussion of the vital question of proper dividend policy to a later section, Chapter 19, where we shall deal with it as a part of the general problem of management-shareholder relations. Capitalization rates for growth stocks. Most of the writing of security analysts on formal appraisals relates to the valuation of growth stocks. Our study of the various methods has led us to suggest a foreshortened and quite simple formula for the valuation of growth stocks, which is intended to produce figures fairly close to those resulting from the more refined mathematical calculations. Our formula is value equals current normal earnings times 8.5 plus twice the expected annual growth rate. The growth figure should be that expected over the next 7 to 10 years. In Table 11.4 on the enhancement, we show how our formula works out for various rates of assumed growth. It is easy to make the converse calculation and to determine what rate of growth is anticipated by the current market price, assuming our formula is valid. In our last edition, we made that calculation for the DJIA and for 6 important stock issues. These figures are reproduced in Table 11.5, which can be found on the enhancement. We commented at the time, the difference between the implicit 32.4% annual growth rate for Xerox and the extremely modest 2.8% for General Motors is indeed striking. It is explainable in part by the stock market's feeling that General Motors' 1963 earnings, the largest for any corporation in history, can be maintained with difficulty and exceeded only modestly at best. The price-earnings ratio of Xerox, on the other hand, is quite representative of speculative enthusiasm fastened upon a company of great achievement and perhaps still greater promise. The implicit or expected growth rate of 5.1% for the DJIA companies, with an actual annual increase of 3.4% compounded between 1951 through 1953 and 1961 through 1963. We should have added a caution somewhat as follows. The valuations of expected high-growth stocks are necessarily on the low side, if we were to assume these growth rates will actually be realized. In fact, according to the arithmetic, if a company could be assumed to grow at a rate of 8% or more indefinitely, in the future its value would be infinite, and no price would be too high to pay for the shares. What the valuer actually does in these cases is to introduce a margin of safety into his calculations. somewhat as an engineer does in his specifications for a structure. On this basis, the purchases would realize his assigned objective, in 1963, a future overall return of 7.5% per annum, even if the growth rate actually realized proved substantially less than that projected in the formula. Of course, then, if that rate were actually realized, the investor would be sure to enjoy a handsome additional return. There is really no way of valuing a high-growth company with an expected rate above, say, 8% annually, in which the analyst can make realistic assumptions of both the proper multiplier for the current earnings and the expectable multiplier for the future earnings. As it happened, the actual growth for Xerox and IBM proved very close to the high rates implied from our formula. As just explained, this fine showing inevitably produced a large advance in the price of both issues. The growth of the DJIA itself was also about as projected by the 1963 closing market price. But the moderate rate of 5% did not involve the mathematical dilemma of Xerox and IBM. It turned out that the 23% price rise to the end of 1970, plus the 28% in aggregate dividend return received, gave not far from the 7.5% annual overall gain posited in our formula. In the case of the other four companies, it may suffice to say that their growth did not equal the expectations implied in the 1963 price, and that their quotations failed to rise as much as the DJIA. Warning: this material is supplied for illustrative purposes only, and because of the inescapable necessity in security analysis to project the future growth rate for most companies studied. Let the listener not be misled into thinking that such projections have any high degree of reliability, or, conversely, that future prices can be counted on to behave accordingly as the prophecies are realized, surpassed, or disappointed. We should point out that any scientific, or at least reasonably dependable, stock evaluation based on anticipated future results must take future interest rates into account. A given schedule of expected earnings or dividends would have a smaller present value if we assume a higher than if we assume a lower interest structure. Such assumptions have always been difficult to make with any degree of confidence, and the recent violent swings in long-term interest rates render forecasts of this sort almost presumptuous. Hence, we have retained our old formula, simply because no new one would appear more plausible. Industry analysis. Because the general prospects of the enterprise carry major weight in the establishment of market prices, it is natural for the security analyst to devote a great deal of attention to the economic position of the industry and of the individual company in its industry. Studies of this kind can go into unlimited detail. They are sometimes productive of valuable insights into important factors that will be operative in the future and are insufficiently appreciated by the current market. Where a conclusion of that kind can be drawn with a fair degree of confidence, it affords a sound basis for investment decisions. Our own observation, however, leads us to minimize somewhat the practical value of most of the industry studies that are made available to investors. The material developed is ordinarily of a kind with which the public is already fairly familiar, and that has already exerted considerable influence on market quotations. Rarely does one find a brokerage house study that points out with a convincing array of facts that a popular industry is heading for a fall, or that an unpopular one is due to prosper. Wall Street's view of the longer future is notoriously fallible, and this necessarily applies to that important part of its investigations, which is directed toward the forecasting of the course of profits in various industries. We must recognize, however, that the rapid and pervasive growth of technology in recent years is not without major effect on the attitude and the labors of the security analyst. More so than in the past, the progress or retrogression of the typical company in the coming decade may depend on its relation to new products and new processes, which the analyst may have a chance to study and evaluate in advance. Thus, there is doubtless a promising area for effective work by the analyst, based on field trips, interviews with research men, and on intensive technological investigation on his own. There are hazards connected with investment conclusions derived chiefly from such glimpses into the future, and not supported by presently demonstrable value. Yet there are perhaps equal hazards in sticking closely to the limits of value set by sober calculations resting on actual results. The investor cannot have it both ways. He can be imaginative and play for the big profits that are the reward for vision proved sound by the event. But then he must run a substantial risk of major or minor miscalculation. Or he can be conservative and refuse to pay more than a minor premium for possibilities as yet unproved. But in that case, he must be prepared for the later contemplation of golden opportunities foregone. A two-part appraisal process. Let us return for a moment to the idea of valuation or appraisal of a common stock, which we began to discuss before. A great deal of reflection on the subject has led us to conclude that this better be done quite differently than is now the established practice. We suggest that analysts work out first what we call the past performance value, which is based solely on the past record. This would indicate what the stock would be worth, absolutely, or as a percentage of the DJIA, or of the S&P composite, if it is assumed that its relative past performance will continue unchanged in the future. This includes the assumption that its relative growth rate, as shown in the last 7 years, will also continue unchanged over the next 7 years. This process could be carried out mechanically by applying a formula that gives individual weights to past figures for profitability, stability, and growth, and also for current financial condition. The second part of the analysis should consider to what extent the value based solely on past performance should be modified because of new conditions expected in the future. Such a procedure would divide the work between senior and junior analysts as follows. 1. The senior analyst would set up the formula to apply to all companies generally for determining past performance value. 2. The junior analysts would work up such factors for the designated companies, pretty much in mechanical fashion. 3. The senior analyst would then determine to what extent a company's performance, absolute or relative, is likely to differ from its past record, and what change should be made in the value to reflect such anticipated changes. It would be best if the senior analyst's report showed both the original valuation and the modified one, with his reasons for the change. Is a job of this kind worth doing? Our answer is in the affirmative, but our reasons may appear somewhat cynical to the listener. We doubt whether the valuation so reached will prove sufficiently dependable in the case of the typical industrial company, great or small. We shall illustrate the difficulties of this job in our discussion of Aluminum Company of America, ALCOA, Alcoa, in the next chapter. Nonetheless, it should be done for such common stocks. Why? First, many security analysts are bound to make current or projected valuations as part of their daily work. The method we propose should be an improvement on those generally followed today. Secondly, because it should give useful experience and insight to the analysts who practice this method. Thirdly, because work of this kind could produce an invaluable body of recorded experience, as has long been the case in medicine, that may lead to better methods of procedure and a useful knowledge of its possibilities and limitations. The public utility stocks might well prove an important area in which this approach will show real pragmatic value. Eventually, the intelligent analyst will confine himself to those groups in which the future appears reasonably predictable, or where the margin of safety of past performance value over current price is so large that he can take his chances on future variations, as he does in selecting well-secured senior securities. In subsequent chapters, we shall supply concrete examples of the application of analytical techniques, but they will only be illustrations. If the listener finds the subject interesting, he should pursue it systematically and thoroughly before he considers himself qualified to pass a final buy or sell judgment of his own on a security issue. Commentary on Chapter 11. Would you tell me, please, which way I ought to go from here? That depends a good deal on where you want to get to, said the cat. Lewis Carroll, Alice's Adventures in Wonderland. Putting a price on the future. Which factors determine how much you should be willing to pay for a stock? What makes one company worth 10 times earnings and another worth 20 times? How can you be reasonably sure that you are not overpaying for an apparently rosy future that turns out to be a murky nightmare? Graham feels that 5 elements are decisive. He summarizes them as the company's general long-term prospects, the quality of its management, its financial strength and capital structure, its dividend record, and its current dividend rate. Let's look at these factors in the light of today's market. The long-term prospects. Nowadays, the intelligent investor should begin by downloading at least 5 years' worth of annual reports, Form 10K, from the company's website, or from the Edgar database at www.sec.gov. Then comb through the financial statements, gathering evidence to help you answer 2 overriding questions. What makes this company grow? Where do and where will its profits come from? Among the problems to watch for, the company is a serial acquirer. An average of more than 2 or 3 acquisitions a year is a sign of potential trouble. After all, if the company itself would rather buy the stock of other businesses than invest in its own, shouldn't you take the hint and look elsewhere too? And check the company's track record as an acquirer. Watch out for corporate bulimics, firms that wolf down big acquisitions, only to end up vomiting them back out. Lucent, Mattel, Quaker Oats, and Tyco International are among the companies that have had to disgorge acquisitions at sickening losses. Other firms take chronic write-offs or accounting charges proving that they overpaid for their past acquisitions. That's a bad omen for future deal-making. The company is an OPM addict, borrowing debt or selling stock to raise boatloads of other people's money. These fat infusions of OPM are labeled cash from financing activities on the statement of cash flows in the annual report. They can make a sick company appear to be growing, even if its underlying businesses are not generating enough cash, as Global Crossing and WorldCom showed not long ago. The company is a Johnny One-Note, relying on one customer or a handful for most of its revenues. In October 1999, fiber optics maker Sycamore Networks Incorporated sold stock to the public for the first time. The prospectus revealed that one customer, Williams Communications, accounted for 100% of Sycamore's $11 million in total revenues. Traders blithely valued Sycamore's shares at $15 billion. Unfortunately, Williams went bankrupt just over 2 years later. Although Sycamore picked up other customers, its stock lost 97% between 2000 and 2002. As you study the sources of growth and profit, stay on the lookout for positives as well as negatives. Among the good signs, the company has a wide moat, or competitive advantage. Like castles, some companies can easily be stormed by marauding competitors, while others are almost impregnable. Several forces can widen a company's moat. A strong brand identity. Think of Harley-Davidson, whose buyers tattoo the company's logo onto their bodies. A monopoly or near monopoly on the market. Economies of scale, or the ability to supply huge amounts of goods or services cheaply. Consider Gillette, which churns out razor blades by the billion. A unique, intangible asset. Think of Coca-Cola, whose secret formula for flavored syrup has no real physical value, but maintains a priceless hold on consumers. A resistance to substitution. Most businesses have no alternative to electricity, so utility companies are unlikely to be supplanted anytime soon. The company is a marathoner, not a sprinter. By looking back at the income statements, you can see whether revenues and net earnings have grown smoothly and steadily over the previous 10 years. A recent article in the Financial Analyst Journal confirmed what other studies and the sad experience of many investors have shown, that the fastest-growing companies tend to overheat and flame out. If earnings are growing at a long-term rate of 10% pre-tax, or 6% to 7% after tax, that may be sustainable. But the 15% growth hurdle that many companies set for themselves is delusional, and an even higher rate, or a sudden burst of growth in 1 or 2 years, is all but certain to fade, just like an inexperienced marathoner who tries to run the whole race as if it were a 100-meter dash. The company sows and reaps. No matter how good its products or how powerful its brands, a company must spend some money to develop new business. While research and development spending is not a source of growth today, it may well be tomorrow, particularly if a firm has a proven record of rejuvenating its businesses with new ideas and equipment. The average budget for research and development varies across industries and companies. In 2002, Procter & Gamble spent about 4% of its net sales on R&D, while 3M spent 6.5%, and Johnson & Johnson 10.9%. In the long run, a company that spends nothing on R&D is at least as vulnerable as one that spends too much. The quality and conduct of management. A company's executives should say what they will do, then do what they said. Read the past annual reports to see what forecasts the managers made and if they fulfilled them or fell short. Managers should forthrightly admit their failures and take responsibility for them, rather than blaming all-purpose scapegoats like the economy, uncertainty, or weak demand. Check whether the tone and substance of the chairman's letters stay constant, or fluctuate with the latest fads on Wall Street. Pay special attention to boom years like 1999. Did the executives of a cement or underwear company suddenly declare that they were on the leading edge of the transformative software revolution? These questions can also help you determine whether the people who run the company will act in the interests of the people who own the company. Are they looking out for number one? A firm that pays its CEO $100 million in a year had better have a very good reason. Perhaps he discovered and patented the Fountain of Youth, or found El Dorado and bought it for $1 an acre, or contacted life on another planet and negotiated a contract obligating the aliens to buy all their supplies from only one company on Earth. Otherwise, this kind of obscenely obese payday suggests that the firm is run by the managers for the managers. If a company reprices or reissues or exchanges its stock options for insiders, stay away. In this switcheroo, a company cancels existing and typically worthless stock options for employees and executives, then replaces them with new ones at advantageous prices. If their value is never allowed to go to zero, while their potential profit is always infinite, how can options encourage good stewardship of corporate assets? Any established company that reprices options, as dozens of high-tech firms have, is a disgrace, and any investor who buys stock in such a company is a sheep begging to be sheared. By looking in the annual report for the mandatory footnote about stock options, you can see how large the option overhang is. AOL Time Warner, for example, reported in the front of its annual report that it had 4.5 billion shares of common stock outstanding as of December 31, 2002. But a footnote in the bowels of the report reveals that the company had issued options on 657 million more shares. So AOL's future earnings will have to be divided among 15% more shares. You should factor in the potential flood of new shares from stock options whenever you estimate a company's future value. Form 4, available through the Edgar database at www.sec.gov, shows whether a firm's senior executives and directors have been buying or selling shares. There can be legitimate reasons for an insider to sell. Diversification, a bigger house, a divorce settlement. But repeated big sales are a bright red flag. A manager can't legitimately be your partner if he keeps selling while you're buying. Are they managers or promoters? Executives should spend most of their time managing their company in private, not promoting it to the investing public. All too often, CEOs complain that their stock is undervalued no matter how high it goes, forgetting Graham's insistence that managers should try to keep the stock price from going either too low or too high. Meanwhile, all too many chief financial officers give earnings guidance, or guesstimates of the company's quarterly profits. And some firms are hypochondriacs, constantly spewing forth press releases boasting of temporary, trivial, or hypothetical opportunities. A handful of companies, including Coca-Cola, Gillette, and USA Interactive, have begun to just say no to Wall Street's short-term thinking. These few brave outfits are providing more detail about their current budgets and long-term plans, while refusing to speculate about what the next 90 days might hold. For a model of how a company can communicate candidly and fairly with its shareholders, go to the EDGAR database at www.sec.gov and view the 8K filings made by Expeditors International of Washington, which periodically posts its superb question-and-answer dialogues with shareholders there. Finally, ask whether the company's accounting practices are designed to make its financial results transparent or opaque. If non-recurring charges keep recurring, extraordinary items crop up so often that they seem ordinary, acronyms like EBITDA take priority over net income, or pro forma earnings are used to cloak actual losses, you may be looking at a firm that has not yet learned how to put its shareholders' long-term interests first. Financial strength and capital structure. The most basic possible definition of a good business is this: it generates more cash than it consumes. Good managers keep finding ways of putting that cash to productive use. In the long run, companies that meet this definition are virtually certain to grow in value, no matter what the stock market does. Start by reading the statement of cash flows in the company's annual report. See whether cash from operations has grown steadily throughout the past 10 years. Then you can go further. Warren Buffett has popularized the concept of owner earnings, or net income plus amortization and depreciation, minus normal capital expenditures. As portfolio manager Christopher Davis of Davis Selected Advisors puts it, if you owned 100% of this business, how much cash would you have in your pocket at the end of the year? Because it adjusts for accounting entries like amortization and depreciation that do not affect the company's cash balances, owner earnings can be a better measure than reported net income. To fine-tune the definition of owner earnings, you should also subtract from reported net income any costs of granting stock options, which divert earnings away from existing shareholders into the hands of new inside owners. Any unusual, non-recurring, or extraordinary charges. Any income from the company's pension fund. If owner earnings per share have grown at a steady average of at least 6% or 7% over the past 10 years, the company is a stable generator of cash, and its prospects for growth are good. Next, look at the company's capital structure. Turn to the balance sheet and see how much debt, including preferred stock, the company has. In general, long-term debt should be under 50% of total capital. In the footnotes to the financial statements, determine whether the long-term debt is fixed rate, with constant interest payments, or variable, with payments that fluctuate, which could become costly if interest rates rise. Look in the annual report for the exhibit or statement showing the ratio of earnings to fixed charges. That exhibit to Amazon.com's 2002 annual report shows that Amazon's earnings fell $145 million short of covering its interest costs. In the future, Amazon will either have to earn much more from its operations or find a way to borrow money at lower rates. Otherwise, the company could end up being owned not by its shareholders, but by its bondholders, who can lay claim to Amazon's assets if they have no other way of securing the interest payments they are owed. To be fair, Amazon's ratio of earnings to fixed charges was far healthier in 2002 than 2 years earlier, when earnings fell $1.1 billion short of covering debt payments. A few words on dividends and stock policy. For more, please listen to Chapter 19. The burden of proof is on the company to show you that you are better off if it does not pay a dividend. If the firm has consistently outperformed the competition in good markets and bad, the managers are clearly putting the cash to optimal use. If, however, business is faltering or the stock is underperforming its rivals, then the managers and directors are misusing the cash by refusing to pay a dividend. Companies that repeatedly split their shares and hype those splits in breathless press releases treat their investors like dolts, like Yogi Berra, who wanted his pizza cut into 4 slices because I don't think I can eat 8. The shareholders who love stock splits miss the point. 2 shares of a stock at $50 are not worth more than 1 share at $100. Managers who use splits to promote their stock are aiding and abetting the worst instincts of the investing public, and the intelligent investor will think twice before turning any money over to such condescending manipulators. Companies should buy back their shares when they are cheap, not when they're at or near record highs. Unfortunately, it recently has become all too common for companies to repurchase their stock when it is overpriced. There is no more cynical waste of a company's cash since the real purpose of that maneuver is to enable top executives to reap multi-million-dollar paydays by selling their own stock options in the name of enhancing shareholder value. A substantial amount of anecdotal evidence, in fact, suggests that managers who talk about enhancing shareholder value seldom do. In investing, as with life in general, ultimate victory usually goes to the doers, not to the talkers. Chapter 12. Things to consider about per-share earnings. This chapter will begin with two pieces of advice to the investor that cannot avoid being contradictory in their implications. The first is, don't take a single year's earnings seriously. The second is, if you do pay attention to short-term earnings, look out for booby traps in the per-share figures. If our first warning were followed strictly, the second would be unnecessary. But it is too much to expect that most shareholders can relate all their common stock decisions to the long-term record and the long-term prospects. The quarterly figures, and especially the annual figures, receive major attention in financial circles, and this emphasis can hardly fail to have its impact on the investor's thinking. He may well need some education in this area, for it abounds in misleading possibilities. As this chapter is being written, the earnings report of Aluminum Company of America, Alcoa, for 1970 appears in the Wall Street Journal. The first figures shown are share earnings little a, 1970, $5.20, 1969, $5.58. The little a at the outset is explained in a footnote to refer to primary earnings before special charges. There is much more footnote material. In fact, it occupies twice as much space as do the basic figures themselves. For the December quarter alone, the earnings per share are given as $1.58 in 1970, against $1.56 in 1969. The investor or speculator interested in Alcoa shares, reading those figures, might say to himself, not so bad. I knew that 1970 was a recession year in aluminum, but the fourth quarter shows a gain over 1969. With earnings at the rate of $6.32 per year, let me see, the stock is selling at 62. Well, that's less than 10 times earnings. Well, that makes it look pretty cheap, compared with 16 times for International Nickel, etc., etc. But if our investor, speculator friend had bothered to read all the material in the footnote, he would have found that instead of one figure of earnings per share for the year 1970, there were actually four. Primary earnings, 1970, $5.20. 1969, $5.58. Net income after special charges, 1970, $4.32. 1969, $5.58. Fully diluted before special charges, 1970, $5.01. 1969, $5.35. Fully diluted after special charges, 1970, $4.19. 1969, $5.35. For the fourth quarter alone, only two figures are given. Primary earnings, 1970, $1.58. 1969, $1.56. Net income after special charges, 1970, 70 cents. 1969, $1.56. What do all these additional earnings mean? Which earnings are true earnings for the year and the December quarter? If the latter should be taken at 70 cents, the net income after special charges, the annual rate would be $2.80 instead of $6.32, and the price 62 would be 22 times earnings instead of the 10 times we started with. Part of the question as to the true earnings of Alcoa can be answered quite easily. The reduction from $5.20 to $5.01 to allow for the effects of dilution is clearly called for. Alcoa has a large bond issue convertible into common stock. To calculate the earning power of the common based on the 1970 results, it must be assumed that the conversion privilege will be exercised if it should prove profitable to the bondholders to do so. The amount involved in the Alcoa picture is relatively small and hardly deserves detailed comment. But in other cases, making allowance for conversion rights and the existence of stock purchase warrants can reduce the apparent earnings by half or more. We shall present examples of a really significant dilution factor soon. The financial services are not always consistent in their allowance for the dilution factor in their reporting and analyses. Let us turn now to the matter of special charges. This figure of $18,800,000, or 88 cents per share, deducted in the fourth quarter, is not unimportant. Is it to be ignored entirely, or fully recognized as an earnings reduction, or partly recognized and partly ignored? The alert investor might ask himself also, how does it happen that there was a virtual epidemic of such special charge-offs appearing after the close of 1970, but not in previous years? Could there possibly have been some fine Italian hands at work with the accounting? But always, of course, within the limits of the permissible. When we look closely, we may find that such losses, charged off before they actually occur, can be charmed away, as it were, with no unhappy effect on either past or future primary earnings. In some extreme cases, they might be availed of to make subsequent earnings appear nearly twice as large as in reality. by a more or less prestigious treatment of the tax credit involved. In dealing with Alcoa's special charges, the first thing to establish is how they arose. The footnotes are specific enough. The deductions came from 4 sources. Management's estimate of the anticipated costs of closing down the manufactured products division. 2. Ditto for closing down Alcoa Castings Company's plants. 3. Ditto for losses in phasing out Alcoa Credit Company. 4. Also, estimated costs of $5.3 million associated with completion of the contract for a curtain wall. All of these items are related to future costs and losses. It is easy to say that they're not part of the regular operating results of 1970, but if so, where do they belong? Are they so extraordinary and non-recurring as to belong nowhere? A widespread enterprise such as Alcoa, doing a $1.5 billion business annually, must have a lot of divisions, departments, affiliates, and the like. Would it not be normal, rather than extraordinary, for one or more to prove unprofitable, and to require closing down? Similarly for such things as a contract to build a wall. Suppose that at any time a company had a loss on any part of its business, it had the bright idea of charging it off as a special item, and thus reporting its primary earnings per share so as to include only its profitable contracts and operations. Like King Edward VII's sundial that marked only the sunny hours. The listener should note 2 ingenious aspects of the Alcoa procedure we've been discussing. The first is that by anticipating future losses, the company escapes the necessity of allocating the losses themselves to an identifiable year. They don't belong in 1970 because they were not actually taken in that year, and they won't be shown in the year when they are actually taken because they've already been provided for. Neat work. But might it not be just a little misleading? The Alcoa footnote says nothing about the future tax saving from these losses. Most other statements of this sort state specifically that only the after-tax effect has been charged off. If the Alcoa figure represents future losses before the related tax credit, then not only will future earnings be freed from the weight of these charges, as they are actually incurred, but they will be increased by a tax credit of some 50% thereof. It is difficult to believe that the accounts will be handled that way, but it is a fact that certain companies which have had large losses in the past have been able to report future earnings without charging the normal taxes against them, in that way making a very fine profits appearance indeed, based, paradoxically enough, on their past disgraces. Tax credits resulting from past years' losses are now being shown separately as special items, but they will enter into future statistics as part of the final net income figure. However, a reserve now set up for future losses, if net of expected tax credit, should not create an addition of this sort to the net income of later years. The other ingenious feature is the use by Alcoa and many other companies of the 1970 year-end for making these special charge-offs. The stock market took what appeared to be a bloodbath in the first half of 1970. Everyone expected relatively poor results for the year for most companies. Wall Street was now anticipating better results in 1971, 1972, etc. What a nice arrangement, then, to charge as much as possible to the bad year, which had already been written off mentally and had virtually receded into the past, leaving the way clear for nicely fattened figures in the next few years. Perhaps this is good accounting, good business policy, and good for management-shareholder relationships. But we have lingering doubts. The combination of widely, or should it be wildly, diversified operations, with the impulse to clean house at the end of 1970, has produced some strange-looking footnotes to the annual reports. The listener may be amused by the following explanation given by a New York Stock Exchange company, which shall remain unnamed, of its special items aggregating $2,357,000, or about a third of the income before charge-offs. Consists of provision for closing Spalding United Kingdom operations, provision for reorganizational expenses of a division, costs of selling a small baby pants and bib manufacturing company, disposing of part interest in a Spanish car leasing facility, and liquidation of a ski boot operation. Years ago, the strong companies used to set up contingency reserves out of the profits of good years to absorb some of the bad effects of depression years to come. The underlying idea was to equalize the reported earnings, more or less, and to improve the stability factor in the company's record. A worthy motive, it would seem. But the accountants quite rightly objected to the practice as misstating the true earnings. They insisted that each year's results be presented as they were, good or bad, and the shareholders and analysts be allowed to do the averaging or equalizing for themselves. We seem now to be witnessing the opposite phenomenon, with everyone charging off as much as possible against forgotten 1970, so as to start 1971 with a slate not only clean, but specially prepared to show pleasing per-share figures in the coming years. Is it time to return to our first question? What then were the true earnings of Alcoa in 1970? The accurate answer would be the $5.01 per share after dilution, less that part of the 82 cents of special charges that may properly be attributed to occurrences in 1970. But we do not know what that portion is, and hence we cannot properly state the true earnings for the year. The management and the auditors should have given us their best judgment on this point, but they did not do so. Provided for deduction of the balance of these charges from the ordinary earnings of a suitable number of future years, say not more than 5. This evidently they will not do either, since they've already conveniently disposed of the entire sum as a 1970 special charge. The more seriously investors take the per-share earnings figures as published, the more necessary it is for them to be on their guard against accounting factors of one kind and another that may impair the true comparability of the numbers. We have mentioned 3 sorts of these factors: the use of special charges, which may never be reflected in the per-share earnings, the reduction in the normal income tax deduction by reason of past losses, and the dilution factor implicit in the existence of substantial amounts of convertible securities or warrants. A 4th item that has had a significant effect on reported earnings in the past is the method of treating depreciation, chiefly as between the straight line and the accelerated schedules. We refrain from details here, but as an example, current as we write, let us mention the 1970 report of Train Company. This firm showed an increase of nearly 20% in per-share earnings over 1969, $3.29 versus $2.76. But half of this came from returning to the older straight-line depreciation rates, less burdensome on earnings than the accelerated method used the year before. The company will continue to use the accelerated rate on its income tax return, thus deferring income tax payments on the difference. Still, another factor, important at times, is the choice between charging off research and development costs in the year they are incurred or amortizing them over a period of years. Finally, let us mention the choice between the FIFO, first in, first out, and LIFO, last in, first out, methods of valuing inventories. An obvious remark here would be that investors should not pay any attention to these accounting variables if the amounts involved are relatively small. But Wall Street, being as it is, even items quite minor in themselves can be taken seriously. 2 days before the Alcoa report appeared in the Wall Street Journal, the paper had quite a discussion of the corresponding statement of Dow Chemical. It closed with the observation that many analysts had been troubled by the fact that Dow had included a 21-cent item in regular profits for 1969, instead of treating it as an item of extraordinary income. Why the fuss? Because, evidently, evaluations of Dow Chemical involving many millions of dollars in the aggregate seemed to depend on exactly what was the percentage gain for 1969 over 1968, in this case either 9% or 4.5%. This strikes us as rather absurd. It is very unlikely that small differences involved in one year's results could have any bearing on future average profits or growth, and on a conservative, realistic valuation of the enterprise. By contrast, consider another statement also appearing in January 1971. This concerned Northwest Industries Incorporated's report for 1970. The company was planning to write off as a special charge not less than $264 million in one fell swoop. Of this, $200 million represents the loss to be taken on the proposed sale of the railroad subsidiary to its employees, and the balance a write-down of a recent stock purchase. These sums would work out to a loss of about $35 per share of common before dilution offsets, or twice its then current market price. Here we have something really significant. If the transaction goes through, and if the tax laws are not changed, this loss provided for in 1970 will permit Northwest Industries to realize about $400 million of future profits within 5 years from its other diversified interests, without paying income tax thereon. What will then be the real earnings of that enterprise? Should they be calculated with or without provision for the nearly 50% in income taxes which it will not actually have to pay? In our opinion, the proper mode of calculation would be first to consider the indicated earning power on the basis of full income tax liability, and to derive some broad idea of the stock's value based on that estimate. To this should be added some bonus figure, representing the value per share of the important but temporary tax exemption the company will enjoy. Allowances must be made also for a possible large-scale dilution in this case. Actually, the convertible preferred issues and warrants would more than double the outstanding common shares if the privileges are exercised. All this may be confusing and wearisome to our listeners, but it belongs in our story. Corporate accounting is often tricky. Security analysis can be complicated. Stock valuations are really dependable only in exceptional cases. For most investors, it would be probably best to assure themselves that they are getting good value for the prices they pay, and let it go at that. Use of average earnings. In former times, analysts and investors paid considerable attention to the average earnings over a fairly long period in the past, usually from 7 to 10 years. This mean figure was useful for ironing out the frequent ups and downs of the business cycle, and it was thought to give a better idea of the company's earning power than the results of the latest year alone. One important advantage of such an averaging process is that it will solve the problem of what to do about nearly all the special charges and credits. They should be included in the average earnings, for certainly most of these losses and gains represent a part of the company's operating history. If we do this for Alcoa, the average earnings for 1961 through 1970, 10 years, would appear as $3.62, and for the 7 years 1964 through 1970 as $4.62 per share. If such figures are used in conjunction with ratings for growth and stability of earnings during the same period, they could give a really informing picture of the company's past performance. Calculation of the past growth rate. It is of prime importance that the growth factor in a company's record be taken adequately into account. Where the growth has been large, the recent earnings will be well above the 7 or 10-year average, and analysts may deem these long-term figures irrelevant. This need not be the case. The earnings can be given in terms both of the average and the latest figure. We suggest that the growth rate itself be calculated by comparing the average of the last 3 years with corresponding figures 10 years earlier. Where there's a problem of special charges or credits, it may be dealt with on some compromise basis. Note the following calculation for the growth of Alcoa as against that of Sears Roebuck and the DJIA Group as a whole. Comment. These few figures could be made the subject of a long discussion. They probably show, as well as any others derived by elaborate mathematical treatment, the actual growth of earnings for the long period 1958 through 1970. But how relevant is this figure, generally considered central in common stock valuations, to the case of Alcoa? Its past growth rate was excellent, actually a bit better than that of acclaimed Sears Roebuck, and much higher than that of the DJIA Composite. But the market price at the beginning of 1971 seemed to pay no attention to this fine performance. Alcoa sold at only 11.5 times the recent 3-year average, while Sears sold at 27 times, and the DJIA itself at 15+ times. How did this come about? Evidently, Wall Street has fairly pessimistic views about the future course of Alcoa's earnings, in contrast with its past record. Surprisingly enough, the high price for Alcoa was made as far back as 1959. In that year, it sold at 116, or 45 times its earnings. This compares with a 1959 adjusted high price of 25.5 for Sears Roebuck, or 20 times its then earnings. Even though Alcoa's profits did show excellent growth thereafter, it is evident that in this case the future possibilities were greatly overestimated in the market price. It closed 1970 at exactly half of the 1959 high, while Sears tripled in price, and the DJIA moved up nearly 30%. It should be pointed out that Alcoa's earnings on capital funds had been only average or less, and this may be the decisive factor here. High multipliers have been maintained in the stock market only if the company has maintained better than average profitability. Let us apply at this point to Alcoa the suggestion we made in the previous chapter for a 2-part appraisal process. Such an approach might have produced a past performance value for Alcoa of 10% of the DJIA, or $84 per share relative to the closing price of $840 for the DJIA in 1970. On this basis, the shares would have appeared quite attractive at their price of $57 1/4. To what extent should the senior analyst have marked down the past performance value to allow for adverse developments that he saw in the future? Frankly, we have no idea. Assume he had reason to believe that the 1971 earnings would be as low as $2.50 per share. A large drop from the 1970 figure, as against an advance expected for the DJIA. Very likely the stock market would take this poor performance quite seriously, but would it really establish the once mighty Aluminum Company of America as a relatively unprofitable enterprise, to be valued at less than its tangible assets behind the shares? In 1971, the price declined from a high of 70 in May to a low of 36 in December, against a book value of 55. Alcoa is surely a representative industrial company of huge size, but we think that its price and earnings history is more unusual, even contradictory, than that of most other large enterprises. Yet this instance supports to some degree the doubts we expressed in the last chapter as to the dependability of the appraisal procedure when applied to the typical industrial company. Commentary on Chapter 12. You can get ripped off easier by a dude with a pen than you can by a dude with a gun. Bo Diddley. The numbers game. Even Graham would have been startled by the extent to which companies and their accountants pushed the limits of propriety in the past few years. Compensated heavily through stock options, top executives realized that they could become fabulously rich merely by increasing their company's earnings for just a few years running. Hundreds of companies violated the spirit, if not the letter, of accounting principles, turning their financial reports into gibberish, tarting up ugly results with cosmetic fixes, cloaking expenses, or manufacturing earnings out of thin air. Let's look at some of these unsavory practices. As if. Perhaps the most widespread bit of accounting hocus-pocus was the pro forma earnings fad. There's an old saying on Wall Street that every bad idea starts out as a good idea, and pro forma earnings presentation is no different. The original point was to provide a truer picture of the long-term growth of earnings by adjusting for short-term deviations from the trend, or for supposedly non-recurring events. A pro forma press release might, for instance, show what a company would have earned over the past year if another firm it just acquired had been part of the family for the entire 12 months. But, as the naughty 90s advanced, companies just couldn't leave well enough alone. Just look at these examples of pro forma flimflam. For the quarter ended September 30th, 1999, InfoSpace Incorporated presented its pro forma earnings as if it had not paid $159 million in preferred stock dividends. For the quarter ended October 31st, 2001, BEA Systems Incorporated presented its pro forma earnings as if it had not paid $193 million in payroll taxes on stock options exercised by its employees. For the quarter ended March 31st, 2001, JDS Uniphase Corporation presented its pro forma earnings as if it had not paid $4 million in payroll taxes, had not lost $7 million investing in lousy stocks, and had not incurred $2.5 billion in charges related to mergers and goodwill. In short, pro forma earnings enable companies to show how well they might have done if they hadn't done as badly as they did. As an intelligent investor, the only thing you should do with pro forma earnings is ignore them. Hungry for recognition. In 2000, QS Communications International Incorporated, the telecommunications giant, looked strong. Its shares dropped less than 5%, even as the stock market lost more than 9% that year. But QWest's financial reports held an odd little revelation. In late 1999, QS decided to recognize the revenues from its telephone directories as soon as the phone books were published, even though, as anyone who's ever taken out a Yellow Page advertisement knows, many businesses pay for those ads in monthly installments. Abracadabra. That piddly-sounding change in accounting principle pumped up 1999 net income by $240 million after taxes, a fifth of all the money QWest earned that year. Like a little chunk of ice crowning a submerged iceberg, aggressive revenue recognition is often a sign of dangers that run deep and loom large. And so it was at QWest. By early 2003, after reviewing its previous financial statements, the company announced that it had prematurely recognized profits on equipment sales, improperly recorded the costs of services provided by outsiders, inappropriately booked costs as if they were capital assets rather than expenses, and unjustifiably treated the exchange of assets as if they were outright sales. All told, QWest's revenues for 2000 and 2001 had been overstated by $2.2 billion, including $80 million from the earlier change in accounting principle, which was now reversed. Capital offenses. In the late 1990s, Global Crossing Limited had unlimited ambitions. The Bermuda-based company was building what it called the first integrated global fiber optic network, over more than 100,000 miles of cables, largely laid across the floor of the world's oceans. After wiring the world, Global Crossing would sell other communications companies the right to carry their traffic over its network of cables. In 1998 alone, Global Crossing spent more than $600 million to construct its optical web. That year, nearly a third of the construction budget was charged against revenues as an expense called cost of capacity sold. If not for that $178 million expense, Global Crossing, which reported a net loss of $96 million, could have reported a net profit of roughly $82 million. The next year, says a bland footnote in the 1999 annual report, Global Crossing initiated service contract accounting. The company would no longer charge most construction costs as expenses against the immediate revenues it received from selling capacity on its network. Instead, a major chunk of those construction costs would now be treated not as an operating expense, but as a capital expenditure, thereby increasing the company's total assets instead of decreasing its net income. Poof! In one wave of the wand, Global Crossing's property and equipment assets rose by $575 million, while its cost of sales increased by a mere $350 million, even though the company was spending money like a drunken sailor. Capital expenditures are an essential tool for managers to make a good business grow bigger and better, but malleable accounting rules permit managers to inflate reported profits by transforming normal operating expenses into capital assets. As the Global Crossing case shows, the intelligent investor should be sure to understand what and why a company capitalizes. An inventory story. Like many makers of semiconductor chips, Micron Technology Incorporated suffered a drop in sales after 2000. In fact, Micron was hit so hard by the plunge in demand that it had to start writing down the value of its inventories, since customers clearly did not want them at the prices Micron had been asking. In the quarter ended May 2001, Micron slashed the recorded value of its inventories by $261 million. Most investors interpreted the write-down not as a normal or recurring cost of operations, but as an unusual event. But look what happened after that by taking a look at Figure 12.1 on the enhancement. Micron booked further inventory write-downs in every one of the next 6 fiscal quarters. Was the devaluation of Micron's inventory a non-recurring event, or had it become a chronic condition? Reasonable minds can differ on this particular case, but one thing is clear. The intelligent investor must always be on guard for non-recurring costs that, like the Energizer Bunny, just keep on going. The pension dimension. In 2001, SBC Communications Incorporated, which owns interests in Singular Wireless, Pactel, and Southern New England Telephone, earned $7.2 billion in net income, a stellar performance in a bad year for the overextended telecom industry. But that gain didn't come only from SBC's business. Fully $1.4 billion of it, 13% of the company's net income, had come from SBC's pension plan. Because SBC had more money in the pension plan than it estimated was necessary to pay its employees' future benefits, the company got to treat the difference as current income. One simple reason for that surplus: in 2001, SBC raised the rate of return it expected to earn on the pension plan's investments from 8.5% to 9%, lowering the amount of money it needed to set aside today. SBC explained its rosy new expectations by noting that for each of the 3 years ended 2001, our actual 10-year return on investments exceeded 10%. In other words, our past returns have been high, so let's assume that our future returns will be too. But that not only flunked the most rudimentary tests of logic, it flew in the face of the fact that interest rates were falling to near-record lows, depressing the future returns on the bond portion of the pension portfolio. The same year, in fact, Warren Buffett's Berkshire Hathaway lowered the expected rate of return on its pension assets from 8.3% to 6.5%. Was SBC being realistic in assuming that its pension fund managers could significantly outperform the world's greatest investor? Probably not. In 2001, Berkshire Hathaway's pension fund gained 9.8%, but SBC's pension fund lost 6.9%. Here's some quick considerations for the intelligent investor. Is the net pension benefit more than 5% of the company's net income? If so, would you still be comfortable with the company's other earnings if those pension gains went away in future years? Is the assumed long-term rate of return on plan assets reasonable? As of 2003, anything above 6.5% is implausible, while a rising rate is downright delusional. Caveat investor. A few pointers will help you avoid buying a stock that turns out to be an accounting time bomb. Read backwards. When you research a company's financial reports, start reading on the last page and slowly work your way toward the front. Anything that the company doesn't want you to find is buried in the back, which is precisely why you should look there first. Read the notes. Never buy a stock without reading the footnotes to the financial statements in the annual report, usually labeled Summary of Significant Accounting Policies. One keynote describes how the company recognizes revenue, records inventories, treats installment or contract sales, expenses its marketing costs, and accounts for the other major aspects of its business. In the other footnotes, watch for disclosures about debt, stock options, loans to customers, reserves against losses, and other risk factors that can take a big chomp out of earnings. Among the things that should make your antennae twitch are technical terms like capitalized, deferred, and restructuring, and plain English words signaling that the company has altered its accounting practices, like began, change, and however. None of those words mean you should not buy the stock, but all mean that you need to investigate further. Be sure to compare the footnotes with those in the financial statements of at least one firm that's a close competitor, to see how aggressive your company's accountants are. Read more. If you are an enterprising investor, willing to put plenty of time and energy into your portfolio, then you owe it to yourself to learn more about financial reporting. That's the only way to minimize your odds of being misled by a shifty earnings statement. 3 solid books, full of timely and specific examples, are Martin Fridson and Fernando Alvarez's Financial Statement Analysis, Charles Mulford and Eugene Comiskey's The Financial Numbers Game, and Howard Schillett's Financial Shenanigans. Chapter 13. A comparison of 4 listed companies. In this chapter, we should like to present a sample of security analysis in operation. We have selected, more or less at random, 4 companies which are found successively on the New York Stock Exchange list. These are Eltra Corporation, a merger of Electric Autolite and Mergen-Taylor Linotype Enterprises; Emerson Electric Company, a manufacturer of electric and electronic products; Emery Air Freight, a domestic forwarder of air freight; and Emhart Corporation, originally a maker of bottling machinery only, but now also in builder's hardware. There are some broad resemblances between the 3 manufacturing firms, but the differences will seem more significant. There should be sufficient variety in the financial and operating data to make the examination of interest. In Table 13.1, found on the enhancement, We present a summary of what the four companies were selling for in the market at the end of 1970, and a few figures on their 1970 operations. We then detail certain key ratios, which relate on the one hand to performance and on the other to price. Comment is called for on how various aspects of the performance pattern agree with the relative price pattern. Finally, we shall pass the four companies in review, suggesting some comparisons and relationships, and evaluating each in terms of the requirements of a conservative common stock investor. The most striking fact about the four companies is that the current price-to-earnings ratios vary much more widely than their operating performance or financial condition. Two of the enterprises, Eltra and Emhart, were modestly priced at only 9.7 times and 12 times the average earnings for 1968 through 1970, as against a similar figure of 15.5 times for the DJIA. The other two, Emerson and Emery, showed very high multiples of 33 and 45 times such earnings. There is bound to be some explanation of a difference such as this, and it is found in the superior growth of the favored company's profits in recent years, especially by the freight forwarder. But the growth figures of the two firms were not unsatisfactory. For more comprehensive treatment, let us review briefly the chief elements of performance as they appear from our figures. 1. Profitability. A. All the companies show satisfactory earnings on their book value, but the figures for Emerson and Emery are much higher than for the other two. A high rate of return on invested capital often goes along with a high annual growth rate in earnings per share. All the companies except Emery showed better earnings on book value in 1969 than in 1961, but the Emery figure was exceptionally large in both years. B. For manufacturing companies, the profit figure per dollar of sales is usually an indication of comparative strength or weakness. We use here the ratio of operating income to sales, as given in Standard & Poor's listed stock reports. Here again, the results are satisfactory for all four companies, with an especially impressive showing by Emerson. The changes between 1961 and 1969 vary considerably among the companies. 2. Stability. This we measure by the maximum decline in per-share earnings in any one of the past 10 years, as against the average of the 3 preceding years. No decline translates into 100% stability, and this was registered by the two popular concerns. But the shrinkages of Eltra and Emhart were quite moderate in the poor year, 1970, amounting to only 8% each by our measurement, against 7% for the DJIA. 3. Growth. The two low multiplier companies show quite satisfactory growth rates, in both cases doing better than the Dow Jones Group. The Eltra figures are especially impressive when set against its low price-to-earnings ratio. The growth is of course more impressive for the high multiplier pair. 4. Financial position. The three manufacturing companies are in sound financial condition, having better than the standard ratio of $2 of current assets for $1 of current liabilities. Emery Air Freight has a lower ratio, but it falls in a different category, and with its fine record, it would have no problem raising needed cash. All the companies have relatively low long-term debt. Dilution note. Emerson Electric had $163 million of market value of low-dividend convertible preferred shares outstanding at the end of 1970. In our analysis, we've made allowance for the dilution factor in the usual way, by treating the preferred as if converted into common. This decreased recent earnings by about 10 cents per share, or some 4%. 5. Dividends. What really counts is the history of continuance without interruption. The best record here is Emhart's, which has not suspended a payment since 1902. Eltra's record is very good. Emerson's quite satisfactory. Emery Freight is a newcomer. The variations in payout percentage do not seem especially significant. Current dividend yield is twice as high on the cheap pair as on the dear pair, corresponding to the price-to-earnings ratios. 6. Price history. The listener should be impressed by the percentage advance shown in the price of all four of these issues, as measured from the lowest to the highest points during the past 34 years. In all cases, the low price has been adjusted for subsequent stock splits. Note that for the DJIA, the range from low to high was on the order of 11 to 1. For our companies, the spread is varied from only 17 to 1 for Emhart to no less than 528 to 1 for Emery Air Freight. These manifold price advances are characteristic of most of our older common stock issues, and they proclaim the great opportunities of profit that have existed in the stock markets of the past. But they may indicate also how overdone were the declines in the bear markets before 1950, when the low prices were registered. Both Eltra and Emhart sustained price shrinkages of more than 50% in the 1969 through 70 price break. Emerson and Emery had serious but less distressing declines. The former rebounded to a new all-time high before the end of 1970, the latter in early 1971. General observations on the four companies. Emerson Electric has an enormous total market value, dwarfing the other three companies combined. It is one of our goodwill giants, to be commented on later. A financial analyst, blessed or handicapped with a good memory, will think of an analogy between Emerson Electric and Zenith Radio, and that would not be reassuring. For Zenith had a brilliant growth record for many years. It too sold in the market for $1.7 billion in 1966. but its profits fell from $43 million in 1968 to only half as much in 1970. And in that year's big sell-off, its price declined to 22.5 against the previous top of 89. High valuations entail high risks. Emory Air Freight must be the most promising of the four companies in terms of future growth, if the price-to-earnings ratio of nearly 40 times its highest reported earnings is to be even partially justified. The past growth, of course, has been most impressive, but these figures may not be so significant for the future if we consider that they started quite small, at only $570,000 of net earnings in 1958. It often proves much more difficult to continue to grow at a high rate after volume and profits have already expanded to big totals. The most surprising aspect of Emory's story is that its earnings and market price continued to grow apace in 1970, which was the worst year in the domestic air passenger industry. This is a remarkable achievement indeed, but it raises the question whether future profits may not be vulnerable to adverse developments through increased competition, pressure for new arrangements between forwarders and airlines, etc. An elaborate study might be needed before a sound judgment could be passed on these points, but the conservative investor cannot leave them out of his general reckoning. Emhart and Eltra. Emhart has done better in its business than in the stock market over the past 14 years. In 1958, it sold as high as 22 times the current earnings, about the same ratio as for the DJIA. Since then, its profits tripled, as against a rise of less than 100% for the Dow. But its closing price in 1970 was only a third above the 1958 high, versus 43% for the Dow. The record of Eltra is somewhat similar. It appears that neither of these companies possesses glamour or sex appeal in the present market. But in all the statistical data, they show up surprisingly well. Their future prospects? We have no sage remarks to make here. But this is what Standard & Poor's had to say about the four companies in 1971. Eltra. Long-term prospects. Certain operations are cyclical, but an established competitive position and diversification are offsetting factors. Emerson Electric. While adequately priced at 71 on the current outlook, the shares have appeal for the long term. A continued acquisition policy, together with a strong position in industrial fields and an accelerated international program, suggests further sales and earnings progress. Emory Air Freight. The shares appear amply priced at 57 on current prospects, but are well worth holding for the long pull. Emhart. Although restricted this year by lower capital spending in the glass container industry, earnings should be aided by an improved business environment in 1972. The shares are worth holding at 34. Conclusions. Many financial analysts will find Emerson and Emory more interesting and appealing stocks than the other two, primarily perhaps because of their better market action, and secondarily because of their faster recent growth in earnings. Under our principles of conservative investment, the first is not a valid reason for selection. That is something for the speculators to play around with. The second has validity, but within limits. Can the past growth and the presumably good prospects of Emory Air Freight justify a price more than 60 times its recent earnings? Our answer would be, maybe, for someone who's made an in-depth study of the possibilities of this company and come up with exceptionally firm and optimistic conclusions. But not for the careful investor, who wants to be reasonably sure in advance that he is not committing the typical Wall Street air of over-enthusiasm for good performance in earnings and in the stock market. The same cautionary statement seemed called for in the case of Emerson Electric, with a special reference to the market's current valuation of over $1 billion for the intangible, or earning power factor here. We should add that the electronics industry, once a fair-haired child of the stock market, has in general fallen on disastrous days. Emerson is an outstanding exception, but it will have to continue to be such an exception for a great many years in the future before the 1970 closing price will have been fully justified by its subsequent performance. By contrast, both Eltra at 27 and Emhart at 33 have the earmarks of companies with sufficient value behind their price to constitute reasonably protected investments. Here the investor can, if he wishes, consider himself basically a part owner of these businesses, at a cost corresponding to what the balance sheet shows to be the money invested therein. The rate of earnings on invested capital has long been satisfactory. The stability of profits also. The past growth rate, surprisingly so. The two companies will meet our 7 statistical requirements for inclusion in a defensive investor's portfolio. These will be developed in the next chapter, but we summarize them as follows. 1. Adequate size. 2. A sufficiently strong financial condition. 3. Continued dividends for at least the past 20 years. 4. No earnings deficit in the past 10 years. 5. 10-year growth of at least 1/3 in per-share earnings. 6. Price of stock no more than 1.5 times net asset value. 7. Price no more than 15 times average earnings of the past 3 years. We make no predictions about the future earnings performance of Eltra or Emhart. In the investor's diversified list of common stocks, there are bound to be some that prove disappointing, and this may be the case for one or both of this pair. But the diversified list itself, based on the listed principles of selection, plus whatever other sensible criteria the investor may wish to apply, should perform well enough across the years. At least, long experience tells us so. A final observation. An experienced security analyst, even if he accepted our general reasoning on these four companies, would have hesitated to recommend that a holder of Emerson or Emery exchange his shares for Eltra or Emhart at the end of 1970, unless the holder understood clearly the philosophy behind the recommendation. There was no reason to expect that in any short period of time, the low multiplier duo would outperform the high multipliers. The latter were well thought of in the market, and thus had a considerable degree of momentum behind them, which might continue for an indefinite period. The sound basis for preferring Eltra and Emhart to Emerson and Emery would be the client's considered conclusion that he preferred value-type investments to glamour-type investments. Thus, to a substantial extent, common stock investment policy must depend on the attitude of the individual investor. This approach is treated at greater length in our next chapter. Commentary on Chapter 13. In the Air Force, we have a rule. Check 6. The guy's flying along, looking in all directions, and feeling very safe. Another guy flies up behind him at 6 o'clock, and 12 o'clock is directly in front, and shoots. Most airplanes are shot down that way. Thinking that you're safe is very dangerous. Somewhere, there's a weakness you've got to find. You must always check 6 o'clock. U.S. Air Force General Donald Cutya. E-business. As Graham did, let's compare and contrast four stocks, using their reported numbers as of December 31st, 1999, a time that will enable us to view some of the most drastic extremes of valuation ever recorded in the stock market. Emerson Electric Company, ticker symbol EMR, was founded in 1890 and is the only surviving member of Graham's original quartet. It makes a wide array of products, including power tools, air conditioning equipment, and electrical motors. EMC Corporation, ticker symbol EMC, dates back to 1979 and enables companies to automate the storage of electronic information over computer networks. Expeditors International of Washington Incorporated, ticker symbol EXPD, founded in Seattle in 1979, helps shippers organize and track the movement of goods around the world. Exodus Communications Incorporated, ticker symbol EXDS, hosts and manages websites for corporate customers, along with other internet services. It first sold shares to the public in March 1998. This table summarizes the price, performance, and valuation of these companies as of year-end 1999, and it can be found on the enhancement. Electric, not electrifying. The most expensive of Graham's four stocks, Emerson Electric, ended up as the cheapest in our updated group. With its base in old economy industries, Emerson looked boring in the late 1990s. In the internet age, who cared about Emerson's heavy-duty wet-dry vacuums? The company's shares went into suspended animation. In 1998 and 1999, Emerson stock lagged the S&P 500 index by a cumulative 49.7 percentage points, a miserable underperformance. But that was Emerson the stock. What about Emerson the company? In 1999, Emerson sold $14.4 billion worth of goods and services, up nearly $1 billion from the year before. On those revenues, Emerson earned $1.3 billion in net income, or 6.9% more than in 1998. Over the previous 5 years, earnings per share had risen at a robust average rate of 8.3%. Emerson's dividend had more than doubled to $1.30 per share. Book value had gone from $6.69 to $14.27 per share. According to Value Line, throughout the 1990s, Emerson's net profit margin and return on capital, key measures of its efficiency as a business, had stayed robustly high, around 9% and 18% respectively. What's more, Emerson had increased its earnings for 42 years in a row, and had raised its dividend for 43 straight years, one of the longest runs of steady growth in American business. At year-end, Emerson's stock was priced at 17.7 times the company's net income per share. Like its power tools, Emerson was never flashy, but it was reliable, and showed no sign of overheating. Could EMC grow PDQ? EMC Corporation was one of the best-performing stocks of the 1990s, rising, or should we say, levitating, more than 81,000%. If you had invested $10,000 in EMC stock at the beginning of 1990, you would have ended 1999 with just over $8 million. EMC shares returned 157.1% in 1999 alone, more than Emerson's stock had gained in the 8 years from 1992 through 1999 combined. EMC had never paid a dividend, instead retaining all its earnings to provide funds for the continued growth of the company. At their December 31st price of $54.63, EMC shares were trading at 103 times the earnings the company would report for the full year, nearly 6 times the valuation level of Emerson stock. What about EMC the business? Revenues grew 24% in 1999, rising to $6.7 billion. Its earnings per share soared to 92 cents from 61 cents the year before, a 51% increase. Over the 5 years ending in 1999, EMC's earnings had risen at a sizzling annual rate of 28.8%. And, with everyone expecting the tidal wave of internet commerce to keep rolling, the future looked even brighter. Throughout 1999, EMC's chief executive repeatedly predicted that revenues would hit $10 billion by 2001, up from $5.4 billion in 1998. That would require average annual growth of 23%, a monstrous rate of expansion for so big a company. But Wall Street's analysts and most investors were sure EMC could do it. After all, over the previous 5 years, EMC had more than doubled its revenues and better than tripled its net income. But from 1995 through 1999, according to Value Line, EMC's net profit margin slid from 19% to 17.4%, while its return on capital dropped from 26.8% to 21%. Although still highly profitable, EMC was already slipping. And in October 1999, EMC acquired Data General Corporation, which added roughly $1.1 billion to EMC's revenues that year. Simply by subtracting the extra revenues brought in from Data General, we can see that the volume of EMC's existing businesses grew from $5.4 billion in 1998 to just $5.6 billion in 1999, a rise of only 3.6%. In other words, EMC's true growth rate was almost nil, even in a year when the scare over the Y2K computer bug had led many companies to spend record amounts on new technology. A simple twist of freight. Unlike EMC, Expeditors International hadn't yet learned to levitate. Although the firm's shares had risen 30% annually in the 1990s, much of that big gain had come at the very end, as the stock raced to a 109.1% return in 1999. The year before, Expeditors shares had gone up just 9.5%, trailing the S&P 500 index by more than 19 percentage points. What about the business? Expeditors was growing expeditiously indeed. Since 1995, its revenues had risen at an average annual rate of 19.8%, nearly tripling over the period to finish 1999 at $1.4 billion. And earnings per share had grown by 25.8% annually, while dividends had risen at a 27% annual clip. Expeditors had no long-term debt, and its working capital had nearly doubled since 1995. According to Value Line, Expeditors' book value per share had increased 129%, and its return on capital had risen by more than one-third to 21%. By any standard, Expeditors was a superb business. But the little freight forwarding company, with its base in Seattle and much of its operations in Asia, was all but unknown on Wall Street. Only 32% of the shares were owned by institutional investors. In fact, Expeditors had only 8,500 shareholders. After doubling in 1999, the stock was priced at 39 times the net income Expeditors would earn for the year. No longer anywhere near cheap, but well below the vertiginous valuation of EMC. The Promised Land? By the end of 1999, Exodus Communications seemed to have taken its shareholders straight to the land of milk and honey. The stock soared 1,005.8% in 1999, enough to turn a $10,000 investment on January 1st into more than $110,000 by December 31st. Wall Street's leading internet stock analysts, including the hugely influential Henry Blodgett of Merrill Lynch, were predicting that the stock would rise another 25% to 125% over the coming year. And best of all, in the eyes of the online traders who gorged on Exodus's gains, was the fact that the stock had split 2-for-1 3 times during 1999. In a 2-for-1 stock split, a company doubles the number of its shares and halves their price. So a shareholder ends up owning twice as many shares, each priced at half the former level. What's so great about that? Imagine that you handed me a dime, and I then gave you back 2 nickels and asked, "Don't you feel richer now?" You would probably conclude either that I was an idiot or that I had mistaken you for one. And yet, in 1999's frenzy over .com stocks, online traders acted exactly as if 2 nickels were more valuable than 1 dime. In fact, just the news that a stock would be splitting 2-for-1 could instantly drive its shares up 20% or more. Why? Because getting more shares makes people feel richer. Someone who bought 100 shares of Exodus in January watched them turn into 200 when the stock split in April. Then those 200 turned into 400 in August. Then the 400 became 800 in December. It was thrilling for these people to realize that they had gotten 700 more shares just for owning 100 in the first place. To them, that felt like found money. Never mind that the price per share had been cut in half with each split. In December 1999, one elated Exodus shareholder, who went by the handle "Gimme a Dollar," exulted on an online message board, "I'm going to hold these shares until I'm 80, because after it splits hundreds of times over the next years, I'll be close to becoming CEO." What about Exodus the business? Graham wouldn't have touched it with a 10-foot pole and a hazmat suit. Exodus's revenues were exploding, growing from $52.7 million in 1998 to $242.1 million in 1999. But it lost $130.3 million on those revenues in 1999, nearly double its loss the year before. Exodus had $2.6 billion in total debt, and was so starved for cash that it borrowed $971 million in the month of December alone. According to Exodus's annual report, that new borrowing would add more than $50 million to its interest payments in the coming year. The company started 1999 with $156 million in cash, and even after raising $1.3 billion in new financing, finished the year with a cash balance of $1 billion, meaning that its businesses had devoured more than $400 million in cash during 1999. How could such a company ever pay its debts? But of course, online traders were fixated on how far and fast the stock had risen, not on whether the company was healthy. "This stock," bragged a trader using the screen name of Launchpad 1999, "will just continue climbing to infinity and beyond." The absurdity of Launchpad's prediction, "What is beyond infinity?" is the perfect reminder of one of Graham's classic warnings. Today's investor, Graham tells us, is so concerned with anticipating the future that he's already paying handsomely for it in advance. Thus, what he has projected with so much study and care may actually happen and still not bring him any profit. If it should fail to materialize to the degree expected, he may in fact be faced with a serious, temporary, and perhaps even permanent loss. Where the E's ended up. How did these four stocks perform after 1999? Emerson Electric went on to gain 40.7% in 2000, although the shares lost money in both 2001 and 2002. They nevertheless ended 2002 less than 4% below their final price of 1999. EMC also rose in 2000, gaining 21.7%, but then the shares lost 79.4% in 2001 and another 54.3% in 2002. That left them 88% below their level at year-end 1999. What about the forecast of $10 billion in revenues by 2001? EMC finished that year with revenues of just $7.1 billion, and a net loss of $508 million. Meanwhile, as if the bear market did not even exist, Expeditors International shares went on to gain 22.9% in 2000, 6.5% in 2001, and another 15.1% in 2002, finishing that year nearly 51% higher than their price at the end of 1999. Exodus's stock lost 55% in 2000 and 99.8% in 2001. On September 26, 2001, Exodus filed for Chapter 11 bankruptcy protection. Most of the company's assets were bought by Cable and Wireless, the British telecommunications giant. Instead of delivering its shareholders to the promised land, Exodus left them exiled in the wilderness. As of early 2003, the last trade in Exodus's stock was at 1 penny a share.